Next, we have there were a lot of questions on buy stops and sell stops as well. And I think buy stops and sell stops, you can use them if you really truly understand your pair. The best pairs to use buy stops and sell stops are when there's a lot of volume in the market. Because what's happening is with buy stops and sell stops, you're expecting price to continue moving. Let's say that you have a support. Let's say you have a support down over here, and you have a candle that's currently moving down, and you're like, okay, well, candle form support, and now I'm expecting the next candle to continue down. So you're going to place a sell stop down over here. A sell stop, what that's going to mean is that you're expecting price to continue through the zone, activate your pending order, and continue moving in that direction. That's why you're using sell stops. The same goes for buy stops. Like if you have a resistance up over here and you have a candle that's moving bullish, and now you have a buy stop up over here, you're expecting the next candle to continue pushing through the buy stop. That's what's happening. You're expecting price to continue moving. That's why you're placing buy stops and sell stops. But it also requires a lot of experience too, because sometimes what happens is that price is going to go up, it's going to activate your buy stop, and then it's going to continue moving down. This is where you're going to say, oh, well, like, you know what, maybe the buy stop did not work, or maybe the sell stop did not work. So when you're coming new to trading, I don't expect anyone to use sell stops and buy stops effectively, or to get like really really good results, because this requires a lot of waiting and watching. Like if we look at pairs like gold or GPJPY, we know that sometimes these pairs, they will break through a zone and they won't do any retests. It's just the way it is. They won't do any retests, and guys will say, "Oh well, like how you could have caught this move." The answer is you don't know how to catch this move. The only thing you can do is maybe have like a buy stop, something that happened on I think on Thursday when GPJPY just went through 133 300. There was no retest. People who had buy stops, they caught that move, and people who just sat and watched, they're like, okay, well, I'm going to watch this happen, and when this happens again, I'm going to be ready. So whenever using buy stops and sell stops, always understand which pair are you using buy stops and sell stops on. The rule of thumb is to always use it on pairs that have a lot of volume and they move really, really quick. Like gold, you have GP CAD, sometimes you have Euro USD, Euro JPY moves a lot. USD JPY has less volume, it doesn't move a lot. Also, when you're looking to see is that, okay, like what time is this going to be a lot of volume too? Like let's say you have news events. Sometimes guys say, hey, I'm going to use buy stops and sell stops on news events because there's a lot of volume in news events. So best pairs to use pending stop orders are high volume pairs or new. So this is risky, right? The probability of success using buy stops and sell stops is low. It's not high. Like let's say when you're waiting for candles to close, the probability of success is high. I'm not going to say it's really high, but it's higher than using a sell stop and a buy stop. So whenever you see that a certain thing to play out has less probability to win, then that means you have to watch it over and over. Like you have to spend more time in understanding why it's happening. What does this mean? Can I effectively use them over and over again? So these things are really important to understand. Also, stop orders are most suited when trading with the trend, and again, it requires some sort of experience and backtesting. Like let's say you're looking at a pair like GPJPY, and we know when GPJPY trends, it trends really, really hard. So, for example, if you have a support form and you have candles that, let's say, we had candles came down, and then you had candles they went up, and then you had candles start to come down, and if someone says, oh, like, what, I missed a move up over here, I couldn't take an entry up over here. So I may want to place a sell stop below the low right over here. Because if GPJPY has a lot of volume, then I'm expecting the next candles to continue down with the trend, break support, activate the sell stop, and continue moving bearish, right? Now, one question can be, oh, okay, well, what if I had a sell stop and my sell stop gets activated? What about the stop loss? Where am I placing your stop loss? The best answer, what I can give safely, like a very conservative stop, is going to be above the candle that's breaking the low. Like the candle that's a breakout candle, like the candle that activates your sell stop, you're putting a stop loss above that candle. But like at the same time, you're watching it as it go. What I've experienced is like sometimes, well, most times when my sell stops get activated, I'm just watching the price. I'm expecting the price to continue going in profits. I'm not expecting to retrace at all. If price starts retracing, let's say 5 pips, 10 pips, then I'm looking to close the order, because effectively, again, I'm sure you guys are making notes. The best way to use buy stops and sell stops, and what to expect from those pending orders, is to see that, okay, price should continue moving in that direction. It should not retrace. It should not come back in the zone. It should not hit your stop loss. It should continue moving. If for some reason your order gets activated and price starts to come up, now you have to say that, okay, you know what? Now I have to close up the trade, because I wanted price to continue down. It didn't continue down, so it makes no sense to hold the trade. This is a very simple concept. Some people, they get caught up in this. When your sell stops get hit or your buy stops get hit, you don't close the position. You keep it open. You have to let it go. If you don't let it go, you're going to go in a drawdown. You're going to start questioning yourself. It just won't make any sense. I have a question here. GJ trend's hard, but there's a certain point in a trend that your confidence to take buys reduces, or you trade the trend until it ends. Yeah, we're going to go over this. Trade and trend, we're going to go. Any question you have regarding this presentation, the question is going to be answered. If it's not answered, you can ask them at the end of the presentation. So for the sake of simplicity and for convenience of the presentation, please keep your questions. Keep them at bay right now. Right? So sell stop and buy stops, you're using them as trend is moving. Then there's another one called a buy limits and sell limits. Those are counter trend orders. I don't use them, so I'm not going to go over them. They are extremely risky. What's basically happening in those orders is that, let's say you have a resistance and you have a support, and let's say you have a buy limit down over here. Buy limit basically means that you're expecting price to come down, activate your order, and then continue moving up. That's what a buy limit is. And then if you have a sell limit up over here, sell limit basically means that you're expecting price to come up, activate your sell limit, and then continue moving down. This is risky because you're trying to trade within the range, or you're trying to call the top or the bottom, right? Let's say price is moving bullish and you have a sell limit up over here. So you're expecting price to come up, activate the sell limit, and continue moving down. But most time what happens is that price will activate the sell limit, come down, and then will continue moving up. All right, someone's trying to see, this is why I don't share these webinars in all the groups. So I think from next time, I'm only going to share them with my groups here. All right, let's do that. Because we have some children here. Okay. Yeah, right. So when you have sell limits, that's what can happen. Like you're essentially calling a top, or you're essentially calling a bottom. So that's why I'm not going to go over sell limits and buy limits. They're reserved for May 17th. There are other groups. Yeah, some smaller groups that are really important. So if the spread is high, you still use sell stops and buy stops? Yes. Sell stops and buy stops are mostly I'm going to use sell stops and buy stops when there's a lot of volume, and when there's a lot of when there's some news events too, right? But it takes experience. I don't expect anyone to use buy stops and sell stops right off the gate. Again, I said you have to do live back testing. You have to sit and watch if you can really use sell stops and buy stops. It's really important. Let's go towards the All right, awesome. So first thing I'm going to do is we're going to do a mic check. I hope the mic is okay.
Audio is coming through straight, no problems. Okay, perfect, awesome. So this is going to be a short webinar. I think we're going to go for about an hour over here. This will be a strictly on impulse entries webinar. Right now, impulse entries are actually, they are really, really risky entries, right? So when you're taking impulse entries, you're basically making sure that price is continuing in the direction you want it to continue, right? So what we're going to start off is, we will start off with the pros and cons of impulse entries, right? What are the pros and cons? The number one pro of impulse entries are that you have an opportunity to grab a move on a pair which does not do a retest at times. You know, like when we have currency pairs like gold or GPJPY or Euro JPY, we know that sometimes, you know, they don't do retests. So if you know how to take impulse entries, or if you have any experience with impulse entries, you'll be able to catch those moves as they continue on, because there's always a probability, right? There's a higher probability that they might do a retest, but then sometimes there's a probability that they will not do retests, right? So we have to keep those things in mind. There's also an opportunity to grab a volume push. What we mean by this is, like, if price is ranging sometimes, you know, when price is ranging, there's going to be a push with volume, right? And when does volume pushes happen? Normally volume pushes happen when you have, you know, market opens, or like, you know, markets about to close, like after news events. That's when you have a lot of volume in the market, right? So that's when impulse entries, they work very well as well. Now, one thing is, they're the same as buy stops and sell stops. Actually, like, you know what, we're going to talk about buy stops and sell stops later on over here. Also, on high volatile events, it's a powerful tool to grab moves, buy stops and sell stops. So what this basically means is, let's say that we have a support down over here, right? And we have a candle which is forming in a way like this, right? So let's say this is a 1 hour candle, or let's say this is a 1 hour or the 4 hour candle. Now, actually, let's put this candle in the middle somewhere over here, right? So if you have a candle right over here, and let's say if this is a 1 hour or the 4 hour candle, and there's news about to happen. So whenever there's going to be news, we're going to know that there's going to be a lot of volume in the market, right? Price will move up and down. Now, this one little thing is really important to note, right? Whenever there's news, the first 15-minute or the first 30-minute candle is really volatile. What this basically means is that the first 15-minute or the 30-minute candle is going to break the highs of the previous candle and the lows of the previous candle, right? So when you see a news candle breaking the highs and the lows, that means there's a lot of volatility. That's a volatile candle. When candles are volatile, we don't know where the candle is going to go. We don't know where the candle is going to close, because it's very volatile, you know. But as soon as that candle ends, like let's say the first candle was volatile, it broke the highs and the lows, then the next candle is going to be formed based on that previous volatile candle. Like if that was bullish, there's a high chance the next candle may go bullish, or if it was bearish, there's a high chance the next candle may go bearish, right? Now, back to buy stops and sell stops. So whenever you're looking at the 30-minute or the 1 hour candles, you're basically saying that, okay, whenever we have volatile news events and you're looking to grab a piece of that move, now this is extremely risky, right? So what's basically happening is you're placing buy stops above the candle high, and you're placing sell stops below the candle low. You know, now the reason why it's risky, because the candles can be very volatile. So what can happen is that price can essentially come up over here, break the high, and then continue moving up. The reason we're putting buy stops here is because once this high is broken, we're counting on the fact that, okay, since this high is broken, now there's a higher probability that the candle will continue on to make a higher like a higher high, you know. And a higher high, it may look something like this, provided that we do not retrace and come back down. The same thing is true for sell stops. You know, like if you have a sell stop below the previous candle low, you're anticipating the next candle to break that low, activate the sell stop, and continue moving down without retracing, right? This is in the best case scenario. And when you're using impulse entries are kind of like the same as buy stops and sell stops. Now, someone can say, can ask that, what about the stop losses? But we're going to go over that here. Like, we're going to go over everything here. So before you even ask questions, everything will be covered. Okay, so of course, like the pros of impulse entries are that you can grab a push when there's no retest. You know, that's basically the only pro you have, but there are a lot of cons as well. The number one con is like stops can be bigger at times when executing impulse trades, right? Now, what do we mean by that? Now, whenever, let's say you have a support forming like this, right? When you have a support forming like this and you have a candle that's closing, let's say somewhere over here, right? You have a candle closing somewhere over here. And the next candle forms something like this. So if you're entering at the bottom right here, your stop is going to be way too big, right? This is sometimes this can happen too. Like as the candles are breaking the lows of the previous candle, your stops become really, really big, and you're like, oh man, like my stop is really big. I'm not sure if I should take this impulse entry. So whenever you think your stop is going to be big, when you're taking an impulse entry, that's probably not going to be a good trade for you to take, because that's something that we don't want, right? Because what's happening is you're expecting price to continue moving bearish without retracing, right? So that's actually very scary. So someone is asking over 15 pips, that's totally up to you. We're not going to discuss how big your stop is going to be. That's for you to decide that based on your risk management. Like if you're okay with 20 pips, 15 pips, 10 pips, that's all on you. But we will continue on, and I hope this question is going to be answered as we move along. Right, so that's one of the cons here. Like your stops can be pretty big when you're looking for impulse entries. Secondly, in some instances, it shows lack of confidence, right? What I mean by this is now, in the past 2-3 months, I've been looking at a lot of charts, and a lot of times, when we have certain confirmations, and certain confirmations are going to look like this, right? You'll have candles coming down, you'll have more candles coming down, and then sometimes you're going to see a candle that's going to be closing bullish like this, right? And this bullish candle is actually going to give you a very, very strong confirmation that price will continue moving up. Now, most times what I will see people do is that they will wait for the next candle to retrace, and then they will wait for the next candle to break the high. Now, what's happening at this point is, as the candle is breaking the high at this point, this is the point where you are entering an impulse entry, right? So when you enter an impulse entry over here, your stop is going to be below the previous candle. Right now, when your stop is going to be below the previous candle, now your stop is going to be much bigger. But if you had enough confidence and you said, okay, like, you know what, even though this candle closed bullish and we're expecting the next candle to go up, I think a better entry would have been right over here, keeping the stop below the previous candle. Now notice how the stop positioning is the same. Whether you're entering up over here, whether you're entering over here, whether you're entering at the retrace of the candle, your stop will always remain the same. Right? But if you're taking an impulse entry once it's breaking the high, provided you have confirmation of a candle closing bullish, then that basically shows lack of confidence. I would say that maybe not even take that trade at all, because now your stop is going to be much bigger and you weren't confident in the first place. So you have to be confident enough to execute the trade so that you have a smaller stop loss. At the same time, if what's happening is, okay, people are asking questions. Okay, please, if you guys don't ask any questions, I'm just gonna close the text box so I don't have to read any questions. Okay, right? Shows lack of confidence. Another thing is, once the candle is breaking the high at this point, right? A conservative stop loss is going to be below the previous candle. Right? That's where you're going to have a conservative stop loss. Aggressive stop is going to be below the current candle. Now, sometimes, I see people make mistakes, and those mistakes are basically like, let's say if this is a 15-minute time frame, right? So we know two things about time frames, like confirmations on time frames. The number one thing is that when you're looking at the 15-minute time frames, the confirmations are going to be very, very weak. So when you're entering an impulse trade, let's say up over here and keeping the stops below the current candle, that's going to be a very weak confirmation, plus that's going to be a very, very weak trade because it's on the 15-minute time frame. What you would want to do is you would want to wait for the 30-minute candle, right? 30-minute candles have much stronger confirmation. So if you have a 30-minute candle breaking the high of the previous candle, your aggressive stop can be below the current 30-minute candle, because the way the trend forms like this, right? We have a high, we have a higher low, we have a higher high, we have a higher low, and we have a higher high, and so on and so forth. So once this candle is breaking the high, you're expecting it to create a higher high, and you're expecting it not to come down and break its own low. This is only valid on strong confirmation time frames, which is the 30-minute time frame, 1 hour time frame, perfect. 4 hour time frame, amazing, right? So this is also happening. You're looking at this to happen in the second half of the candles too, right? So if we go down to the 30-minute time frame now. So let's say that this was the 30-minute time frame, and let's draw our 15-minute candles with our red, right? So let's say that this is the 15-minute candles, coming up, whatever, we're going up, and then they're coming down to close right over here. So these 3 candles. Okay, so now we're going to start with the formation of the second 30-minute candle, right? So second 30-minute candle, let's say kind of like 15-minute candle, looks like this. This is the first 15-minute candle of this 30-minute candle. When the first 15-minute candle is closing bullish and the next 15-minute candle is going up, you're expecting the next 15-minute candle to continue on bullish. Because when you have this 30-minute candle forming, right, you're expecting the second 15-minute candle to continue bullish so that the overall 30-minute candle starts to go bullish as well. This, if this is getting confusing, I think you need to go over the candle pattern section from the unlearn and relearn section there in the database. So right now, so you should know how to break down candles. So that's what it is. Like when you're entering impulse trades on a very strong confirmations, that shows you have lack of confidence, and lack of confidence, man, that can make you have a very, very big stop loss, right? So always have confidence. If you see some strong confirmations, just take the trade, have a stop, and just let it run. Thirdly, candle can create a wick and pull back and draw down, right? Impulse entries, another con is like this. So what sometimes happens is that as you're waiting, as the price is consolidating, right? Let's say price is at a support and we're just hanging out here on the support. What's going to happen is like, okay, let's just draw our range over here, right? So we have candles in this range over here. I mean, I'm drawing very rough candles, whatever, right? We get the idea. So you have candles here in the range. Now, let's say if you're waiting for the next candle to kind of like break below, as it's breaking below, now once price is in consolidation and as price is breaking the low of the previous candle, what some people are going to do is they will take sells. Now when you're taking a sell, you're taking a sell before the candle is even closing below consolidation. That's a very, very risky trade to take, because more often than not, what's going to happen is that as you take a sell at this point, the next candle can just move right back in the range. That happens to a lot of people, and that's actually very sad. Because when you have like only one trade to take, or you have like 2 trades to take, and you take a trade and it's like in an impulse entry when candle is breaking consolidation but hasn't broken down, you take a sell and price just moves back up, man, your one chance of that trade is just gone. Right? So you have to realize that once price is consolidating, you have to wait for price to break and close below that level. If you don't wait for price to close and break below level, man, you're breaking a very fundamental rule of trading. That's a very fundamental rule of price action. When price is consolidating, we always wait for a break and close, right? Because what's going to happen is that, actually, you know what? We're going to talk about that later on here in the slides about impulse entries through consolidations. That's actually a very important subject there. Okay, let's keep moving on. You can also get caught in selling a low or buying a high, right? This is also a very high probability of this happening as well. Now, the reason why this happens is, like, let's say we have supports down over here and prices, moving up very nicely. We're moving up over here. It's moving up furthermore. It's creating a high. And then you have a candle coming down like this. We move down furthermore like this. We move down, and then you have a confirmation, and your confirmation comes like this. You have a confirmation of a candle closing bullish like this, right? So once you have a candle closing bullish, a very easy trade is going to be that, okay, the next candle should continue up to fill this range, and we're going to have a great day. Perfect. But what happens when you miss that trade, right? When you miss that trade moving up, what sometimes the guys are going to do is they'll be like, okay, you know what? As the next candle starts to break the high, I'm going to take a trade. So now you're taking a trade on the top right over here. So as the next candle breaks the high, we don't know whether it's going to go up to create a wick and come down, or is it going to continue moving up? The higher probability is that as price reaches a zone to the left-hand side, there's a very high probability that price will reject that area, or maybe like, wick outside of that area and come back down. That's a very high probability that can happen too. I know, and I've gotten a lot of charts over the past 2-3 months where people have actually, they've missed out on the move going up to fill the range, and then they've taken an impulse entry as price was breaking the top, anticipating price to continue moving bullish. Right? If you're looking at that on the 30-minute time frame or on the 1-hour time frame, you have to understand, once a range is being filled on the 30-minute time frame or the 1-hour time frame, that means it's approaching a resistance. And when you have a resistance or a support on the 1-hour or 30-minute time frame, that's a very strong zone, and there's a high probability that price will reject that area. So taking an impulse entry at that point becomes really, really risky, right? Especially if you've missed this move up. So you have to wait. Once you miss this move up, you have to look at yourself in the mirror and say, hey, like, you know what, man, you missed the move. And once you've missed the move, you got to come back for the next day to see if you can get the same move. Or if price does break above this area, then you wait for a retest and whatnot. And that's something we all know, and we're going to talk about that later on here as well. The fifth point here is going to be that it's risky and more aggressive when choosing not to wait for a retest, right? What we mean by this is that sometimes what's going to happen is that you have, let's say you have a support, right? We have a support over here, and now what we're doing is we are anticipating. So now sometimes what's going to happen is we're going to have a candle closing like this, right? We're going to have a candle closing like this, breaking below the support, closing below the support, and let's say this is a GPJPY. Actually, so we have a resistance up over here, and we have support down over here at this point, right? Let's just make a little boundary on the support. Make it look like a neon sign. Perfect. So if you have candle closing, breaking, and closing below support. Now, what's going to happen is sometimes, what we're going to do is we're like, okay, you know what? Since if this is GBPJPY, or if this is gold, or if this is some high volume pair, we know that sometimes price does not do a retest. So, right, sometimes what's going to happen is that as the next candle is doing a retest up there, and it's starting to come down to break the low, as it's breaking the low, we will enter a sell. We're enter a sell because, price is breaking the low, and now there's a high probability for price to continue down. But sometimes what can happen is that this candle can maybe close at this point, and then we can have the next candle coming right back up. This happens to a lot of people too. Or what might happen is that once that candle is pulled down, that same candle can pull right back up too. There's a high probability that can happen as well. So whenever you're taking impulse entries, when price is breaking and closing below support, and you're looking for the next candle to break the low, you have to accept the fact that, okay, since you're taking an impulse entry, this is extremely risky because now you're selling the low over here, anticipating price to continue moving down. Sometimes this will happen when there's a lot of volume. When you're walking into New York Open, NYC Open, London Open, those things may happen, but then there's also a high probability that price may move down and then continue back up to do a retest in order to continue the move down, right? So what I would say is whenever you're faced with a situation like this, it's always a good idea to just sit back and watch, because these are extremely risky trades. So if you have only one trade to take, 2 trades to take, and you want to take a trade based on the fact that, okay, next candle is breaking the low, and you haven't watched this enough happen in the market, there's a very high chance you're going to lose the trade. And once you lose the trade, you're going to be very disheartened because you'll be like, oh man, like I was waiting for this, I took the trade, and Raja Bank says it works, and now it didn't work, because you haven't watched it enough. Because the thing is, the more you watch these things happen, the more you miss out on impulse entries like this, the more you're going to be experienced enough. The more you're going to know, okay, like, I've missed out on this trade a couple of times. Maybe this is not the right trade for me to take. Because some people, if they see that, they're like, okay, we're just going to wait. A lot of times when I see candles breaking the lows like this, I'm just like, hey, like, I'm just going to wait for a retest. Because sometimes I'm not confident enough, but most times when you are confident enough, you're like, okay, I'm willing to take this aggressive trade. And when we're talking about risk and aggressive trades, you're always reducing your risks. Because when impulse entries are aggressive trades, and I tell everybody, if you're going to take impulse entries, reduce your risk. If let's say you're going to come in the market with 2% risk per trade, right? And 2% risk per trade should only be done on strong confirmation price action setup. You know what I mean by that is, like, let's say if you have a breakdown, price comes up, creates a resistance, that's the point you should be entering your 2% or 1% or whatever risk you're using, right? But once price is breaking the low, this becomes really aggressive. So once that's happening, you're reducing your risk from 2% to 1%. I'm going to try to draw one with arrows over here, right? So this is 1% right over here, right? This is 1%. So whenever you have an aggressive entry opportunity, you're always reducing your risk. Because let's say if you take this trade, it's an aggressive trade, impulse entry, you only used 1%. If this is a loss, right, then you can give your trade a second chance, right? Because instead of using 2%, you used 1%, you lost the trade, now you got 1% left, and now you can say, okay, you know what, I'm going to wait for a retest, and then I'm going to enter my other 1% and then take a trade for price to continue moving down. Someone's asking a question, even though I said no questions right now. Raja, could a strong confirmation plus impulse entry improve our win rate? No, I just said it's very risky. So whatever you can make up in your mind to justify an aggressive trade, impulse trade, it's still going to be an aggressive trade. So you're always reducing risk. All right, so let's move along over here. So guys, please, let's save our questions till the end of the presentation because I move with the flow. So when you're asking questions during my flow, it breaks the entire flow. So next person to ask a question, I'm just going to remove you and you can watch a recap, right? So let's save the questions till the end. Okay, it requires a lot of experience in trading the trends and breakouts, you know, because whenever price is trending, you're actually looking to see that, okay, if this is actually going to continue on, you know, so it requires a lot of experience. So, you know, impulse entries, I'm still perfecting them. I'm still not an expert at impulse entries because they're extremely risky. There's a high chance of losing, right? There's a high chance of losing, but if you're managing your risk, I think it's great because once you're managing risk, you're losing less, but when it continues on, you're making more than what you're risking. So it requires a lot of experience in watching the market move, in watching price move. Listen, I tell people all the time that whenever you're looking for impulse entries, be prepared to miss out on trades because the more trades you miss out on, the better you're going to get at them. Because when you miss out on trades, you can look back and see that, okay, maybe this is where I could have entered the trade. Maybe I could have done things different this way and that way. So, like, you know, it helps you a lot. So, impulse entries, when to anticipate them, you know, when there's volume in the market during an impulse entry, you're really expecting price to continue its momentum in the direction the trend is, right? That's when we're anticipating price to continue on. We've done these examples a lot, and I'm going to repeat them here again. Let's say you have a resistance up over here, and you have price coming down, right? We have price coming down like this, and price is like really trying to make a low, and then what's going to happen is you're going to have some sort of a retracement. Whenever you're going to have some sort of a retracement and you have a confirmation of resistance forming up over here, then you know, okay, like, you know what, maybe this is a higher time frame resistance, maybe like a daily resistance or weekly resistance, and on the 4 hour or on the 1 hour, you're getting confirmations of candles turning bearish here. Now you're going to know, okay, like, you know, first things first, you will want to know if you have enough range. If this range is enough for price to drop down right over here, right? So if you're like, okay, you know what, this is a 30 pip range or 35 pip range, then you know, okay, like, you know what, if this is NYC Open or pre-London or London Open, there's a lot of volume in the market. And whenever there's volume in the market, price is going to continue down to retest this low and then hopefully, you know, continue breaking down and move further down, right? So whenever you're looking for impulse entries, you're always looking to see if there's volume in the market. Whenever there's going to be volume in the market, candles will move, candles will break the lows or break the highs. That's basically what impulse entries are. You know, impulse entries are when you're taking an entry, you're expecting price to break the low or the high, and you're expecting price to continue moving. Just like your buy stops and sell stops. Now, what is a trend? It's a structure where price creates a new high and then retraces to form a support resistance in order to retest the new high or the low, right? We've discussed this in great detail in the unlearn and relearn section. So, like, you know, if someone's still confused on that, you'll have to go look at that section. Because impulse entries, this section here, this is a prerequisite of those, like, you know, earlier sections we had. During high volume hours, market open, post news, price is most likely to form a trend. Whenever there's high volume, whenever there's a lot of volatility in the well, not volatility, whenever there's like a lot of volume in the market, when orders are being opened and closed, price is most likely to form a trend. Sometimes what's going to happen is that we will have consolidation. Let's say we're going to have a consolidation box right over here, and what price is going to do is, let's say sometimes price is just going to bounce around in this box. We're going to have consolidation, price is going to go up, price is going to start to break the high of the previous candle, someone's going to take a buy, and price will come back down, and they're like, oh man, I got stopped out, whatever, because you tried to trade the consolidation. Whenever there's consolidation, you're waiting for price to break and close outside of consolidation. Now, when price is going to continue moving out of consolidation, this is a very, very low probability, right? It's very rare that price breaks consolidation and continues moving without a retest. It's very rare, but it does happen, and sometimes when you catch that move, there's no way to explain it other than the fact, oh yeah, you know what, there was a lot of volume in this pair, and I've seen it happen a lot, and I took this trade and I won the trade. It's very rare that happens, but it does happen. So you're always waiting for price to consolidate and then move. So whenever price is also consolidating, you're always looking at the time. Let's say if you trade the London session, and let's say during pre-London you see prices consolidating. Whenever price is consolidating in pre-London, you're always looking to see that, okay, when is going to be the next time of volume? You're not looking to see, okay, when it's going to break. You're keeping an eye on when there's going to be next time of volume. So next time of volume is going to be at London Open. If pre-London was consolidating, then there's going to be London Open. In the same way, if you wake up for pre-New York and pre-New York is ranging like this, you're looking at the time. You're looking to see that, okay, if we're ranging at this point, when is going to be volume next time? Then okay, the next time there's going to be volume is going to be in New York Open. If New York Open is ranging, there's going to be volume at NYC Open, and then London close, and so on and so forth, right? So you're always looking at times when there's going to be volume in the market, and then based on that volume, you're anticipating the consolidation to break, right? So that as well, it takes a lot of practice. It takes a lot of experience in watching it happen over and over again, right? So if you've been on a live stream like for the last year and a half, you basically have some sort of experience in that domain there. When candles are making higher highs or higher lows, you're anticipating continuation pushes, right? What this means is that whenever you have candles that are making, let's say, that are moving up from a support area, let's say you have a support area down over here, and you have a candle closing like this, and you're taking an impulse entry, let's say the next candle wicks down and comes up to break the high, this is where you're taking impulse entries right at this point. At this point, you're taking impulse entries and you're anticipating the candle to continue moving up. Now, how far can the candle move up to? I know someone's going to have this question. We're going to cover this question later on here as well. So basically, you're just anticipating candles to make higher highs and higher lows. In the same way, if candles are moving down, you're expecting them to create lower lows and lower highs. So you're entering when the candle is breaking the low of the candle in a bearish trend or a high of a candle in a bullish trend. Right? So conservative stops are placed based on the previous candle. This is something we also talked about. What this basically means is that if you have a resistance forming and you have a candle closing bearish at this point, right? So before we had a candle closing bearish, we had, let's say, candles moving up. Right, so once you have your confirmation here, okay, candles closing bearish, this is a 30-minute time frame or this is a 1-hour time frame, and there's a very high probability for the next candle to continue bearish. What you can do is, okay, like, you know what, then you're going to say, okay, maybe if I'm going to do an impulse entry, I'm entering once we break the low of the previous candle, and you're placing the stops based on the previous candle. So this means you're placing the stop loss right over here, like above the previous candle. That's a conservative stop right over here, right? That's a conservative stop. Aggressive stops are placed based on the current candle. This means is that as we're breaking the low right over here and you're entering the sell as an impulse entry, you're putting a stop loss above the current candle, because as it's breaking the low, you're making sure that, okay, you're basically believing the fact that, okay, as it breaks the low, it's going to create a lower low, and once price creates a lower low, it has to create a lower high. And if you're placing a stop above the current candle, you're also making sure that, okay, then maybe that's going to be our lower high for price to continue moving down, and then you can expect the next candle to kind of retrace and continue moving bearish. That's all what this means. Like, aggressive stops are placed based on the current candle, conservative stops are placed based on the previous candle, right? And this is with the aggressive stops, this is something you learn with experience. This is something you learn, like, as you take positive trend trades, as price is breaking the high and the low and you're looking at the candles, you're like, okay, well, maybe I could have had an aggressive stop above the current candle, and so on and so forth. So that all comes down with experience and watching these things happen over and over again. All right, let's move on. Impulse entries during trends, right? Now, there are types of impulse entries, right? There are only two types of impulse entries that I could maybe look back at my trading and I could basically see. And the first type was the during trends, whenever price is trending, right? As price is trending, it's making a series of higher highs and higher lows as it's moving bullish, and lower lows and lower highs as it moves bearish, right? Everybody knows this, really simple, no secret over here. The above statement is true based on a strong confirmation time frames, such as a 30-minute plus, right? If you're looking at the 15-minute time frames and candles are making higher highs and higher lows, I think that's going to be a very weak confirmation time frame, because what can happen is, essentially, if you have a resistance forming and you have a candle that's giving you your bearish confirmation, and let's say you're looking at a 15-minute time frame, right? Let's say this is a 15-minute time frame. Now, what can happen is there's a high probability that the next 15-minute candle can wick all the way up and then continue moving bearish, right? That can happen on the 15-minute time frame, which is why we don't look at the 15-minute time frame as much. With experience, you can make a bias sometimes by looking at the 15-minute, but for starters, I would maybe anticipate not to look at the 15-minute time frame. So when you're looking at the 30-minute time frame, there's a low probability that the candle can break the high of the previous candle, because the trends are much stronger in the 30-minute time frame. Same thing goes for the 4-hour time frame, right? If you're looking on the 4-hour time frame or the 1-hour time frame, there's an even less probability that the next candle will break the high of the previous candle, right? So they're all probabilities. So you're always looking at where's going to be a strong probability. Now, when you're looking at the 15-minute or the 5-minute, like sometimes, those are very weak confirmation time frame. There's a very high chance you're going to lose on that trade. And it also shows that you're being impatient. You don't want to wait, because when you're waiting for the 30-minute candles, you're basically waiting 30 minutes. You're basically waiting 30 minutes. That's a long time to wait for candles to form, right? So that's going to be a much better confirmation when you're looking for the 30-minute time frames. Now, since we look at the 30-minute time frames or confirmations, we also have to keep in mind the range on the same time frame. Sometimes what's going to happen is that guys are going to say, hey, Raja, so we're going to go to that example over here. If we want price to continue in momentum by breaking the highs or the lows, then we also want enough range to be present to justify that movement. For example, right? Let me just get this coffee over here. Coffee is so nice. So basically, let's say we have the support over here and we have a candle closing bullish. Next candle form is bullish, next candle form is bullish. But now if you notice, the body of the next candles becomes smaller and smaller. Now, when the bodies of the candles, they become smaller, that means the volume is decreasing in that candle. So if we're moving bullish over here and the candle bodies are becoming smaller, that means the volume is decreasing, right? There's a very high chance that we will see some sort of a, reversal when candle bodies become smaller. But there's also a tiny bit of probability that price may continue moving bullish, something like this, right? So sometimes what's going to happen is that when you see small body candles, guys are going to enter trades. They will enter a sell. They will say, small body candles mean less volume. Prices may reverse, so let's take a better entry. No, you have to wait for candle to close in your direction, right? So again, you have a small body candle, small volume, and then you have a bearish candle forming like this. Now notice how before this bearish candle formed, it went up and it broke the high of the previous candle. This is the wrong time to take an impulse trade, because the reason why is because we've already had a movement up like this. So sometimes when you're going to wake up, you're going to come to the charts, you're going to see candles forming like this, and when you see a move that has already happened and then the next candle breaks the high, you're going to get the smart ass idea to take a sell, oh no, to take a buy. You're like, okay, we're breaking the high. Let me get my arrow over here. So we're breaking the high at this point. Let's take a buy. You're going to take a buy. You're going to put the stop loss below the candle, and you're going to get stopped out, because you're going to be looking at your trade, which you can profit from up over here, but you're not looking at all this move up that happened. You know, whenever you see a move up like this happen, you're like, okay, you know what? A move up like this happened, and if we're forming a bearish candle, this means that we may be creating a high right at this point. You know, we may be creating a high, and there's a chance that price may continue up to retest that high. So we're going to look at this example from a impulse entry perspective, right? We're not going to look at this from like, you know, confirmations or stuff like that. We're not going to look at this from an impulse entry perspective. So let's say you're waiting, the next candle form is bearish, next candle form is bearish. You're like, okay, you know what? I'm going to wait for price to maybe form a bullish candle, and there we go. We got a candle forming bullish. Now, if this is a 1 hour time frame, right? Let's say this is a 1 hour time frame. So if this is a 1 hour time frame, on the 15-minute time frame, what you might see is that when you drop down to the 15-minute time frame, where's my blue color here? Okay, you might see some sort of a minor resistance at this point. Right. So sometimes what happens during the live streams is that someone's going to execute a trade on the 30-minute time frame, or on the 1 minute time, or a 1 hour time frame, and what they will do is they will measure this range. So once they measure this range, they will say, okay, you know what? This is a 35 pip range. So this is a 35 pip range on the 1 hour time frame. But when you see a minor resistance on the 15-minute time frame, right over here, now you are introducing complications in your trading idea. Because now what you're saying is that, oh, okay, well, since on the 1 hour we have this 35 pip range, but hey, man, there's this minor resistance on the 15-minute time frame, which is only like 15 pips away. So maybe we have to look at that area. I get these questions all the time. You know, whenever I take a trade, guys are like, oh, well, there's a minor resistance in this area. Aren't you scared of that minor resistance? And the answer is no, because when you're waiting for a confirmation on a 30-minute time frame, you're looking at the 30-minute range. If you're waiting for confirmation on the 1 hour time frame, you're looking at the 1 hour range, because now the smaller resistances on the time frames, on the smaller time frames, they do matter to some extent, but in the grand scheme of things, like let's say on a 30-minute or a 1 hour, they don't really matter, because that minor resistance can be broken on your 1 hour confirmation time frame. You know, which is why we say over here, since we're looking at the 30-minute confirmations, we also have to keep in mind the range on the same time frame. You know, because as the 30-minute candle starts breaking the high over here, let's see over here, right? As the next candle starts breaking the high, now we're approaching this minor resistance, and you're basically anticipating the candle to continue moving bullish. You know, so sometimes what's going to happen is that as price is breaking the high, so let's say someone entered, let's say that someone entered as this candle started to break the high of the previous candle. You know, if you enter right over there, now obviously your conservative stop is going to be below the previous candle. Your aggressive stop is going to be below the current candle. You know, and as we broke the high, now you're expecting the next candle to go up. Now, if we only, now let's only focus on this 30-minute candle right over here, right? Let's focus on this 30-minute candle right over here. Now, let's say before this 30-minute candle completed, this 30-minute candle may look something like this on the 15-minute time frame. So let's say this is the 15-minute candle, and then we have, actually, let me just bring that hollow candle, and the hollow candle is going to maybe look something like this, right? So on the 15-minute time frame, this could be the start of the new 30-minute candle, which could be right over here, creating a lower wick. And the next 15-minute candle can essentially continue bullish, making the complete 30-minute candle go bullish. Makes sense? So I'm going to repeat this again, right? I'm going to repeat this again. So let's go back to our, so let's say this is a 30 pip range we have, right? We have a 30 pip range and the candle has closed bullish at the bottom, and you're like, okay, you know what? I'm not confident in taking a trade as the candle is closing. I'm going to wait for price to break the high of the 30-minute time frame. So let's say you enter a buy as price breaks the high, and like, you know, you put your stop loss below the previous candle, conservative stop loss, aggressive stops below the current candle, and the price goes up and it closes bullish. Now, someone who's not as confident, they might say, oh, like, you know what, there's a 15-minute resistance here, and if this was the start of the 30-minute candle and the 15-minute candle closed bearish, someone's going to say, okay, yeah, you know what, the 15-minute is rejecting that resistance. But the whole concept is, if the 15-minute candle is closing bearish at this point and you are already in a trade, maybe this is the point for you to close a partial of your position. You know, maybe look, you can look back and say, okay, like, you know what, if this candle is closing bearish, maybe I want to take off 50% because I'm getting scared of this 15-minute resistance, even though the 30-minute candle is still open. And while you're waiting for the next 15-minute candle, next 15-minute candle goes bullish, pushing the overall 30-minute candle bullish, right? So sometimes what's going to happen is guys are going to close their entire position at this stage because they will not trust the higher 30-minute candle time frame. You know, so instead of closing the whole position, just close 50%. Because if you close 50%, 70%, or whatever percentage you have in mind, that's totally up to you. That's personal preference. You're at least going to still be in the trade. You know, so once that candle closes bullish, now you're expecting the next candle to continue breaking the high and continue moving up, and so on and so forth, right? So you're always keeping in mind how the 15-minute candles are closing on the 1 30-minute time frame. And whenever you see minor resistances on the 5-minute or 15-minute, always understand that if you have confirmation on the 30-minute or in the 1 hour, you should put more weight on that confirmation. You know, don't let these small things, you know, like sway you off of your analysis. You know, those small things really don't matter. All right, so how's my pace? Good? Good pace? Fast? Slow? Like, good? Good? Perfect. Well done. Okay, awesome. Perfect. All right, let's go to the next slide over here. Now, these are some examples we have based on impulse entries, and we're going to be looking at the impulse entries scenarios at this point. So what we're going to do is we're going to go to the next slide here. Now, we have a high being formed right over here, right? Price came up, price made a high, next candle came down, and candle closed with no wick at the bottom. So whenever candle is closing with no wick at the bottom, this means there's no range for the next candle to go down. You know, there's no range. And also now there's a 50-50 chance that next candle can go down or it can go up. So what we have to do, we have to wait for the next candle to form. So let's see how the next candle forms. Next candle goes bearish, right? There's a 50-50 chance. Now, this is where a lot of people take some losses, because whenever candles close with no wick at the bottom, you're basically sitting out, you're waiting to see how the next candle forms. And the next candle forms a weak bearish candle. This means like, okay, before this candle formed, this candle was extremely bearish coming all the way down, you know, and then it closed like a weak bearish candle. So whenever you have a candle closing with no wick at the bottom or the top, just wait for the next candle to form, just like right over here, right? This candle formed with no wick at the top. We don't know if the next candle is going to go up or down. We waited for the next candle to form. Next candle closed bullish, making higher highs and higher lows. You had consolidation there, and you know, price went up, came down, and now we have over here. Now at this point, we're still waiting. We're waiting for the next candle. Oh, so next candle continues moving bearish. Okay, that's fine. Still over here, there was no trade. There was no opportunity for us to take a trade. Now what's happening is we are approaching a support. Now, a support is drawn based on the wicks and the bodies, right? I basically like to cover the wicks, and it's basically below the bodies, because we're looking at where the lows are, right? Where the candles are closing right over here, right over here, right over here. So let's go to the next candle and see how the next candle prints over here. Next candle is printing bullish. We see a big rejection at the bottom. Candle's closing bullish. Now, this is where a stop is going to be really big, right? If you're taking a buy at this point, your stop is going to be pretty big. So let's say this is a GPJPY 30-minute time frame. This could be like a 15 to 20 pip stop. You know, for some people, they'll say, okay, like, you know what, if this is a 15 to 20 pip stop, I may want to reduce my risk and still take this trade. But for some people like me, I'm going to say, well, you know what, since this candle closed with a wick at the top, and I mean, there's a big rejection, the stop is too big, I may want to wait for the next candle to form and see if I can take a trade at that point, right? Next candle closes bullish. Now, next candle is closing bullish. Now, if we look at this, right, this body is kind of like the same length as the previous body, which means there is still volume in the trade right now. So now, two things can happen at this point. Someone can turn around and say, okay, you know what? I'm going to take an entry at this point, right? I'm going to take an entry at this point, and I'm going to keep my stop. Oh, let me just remove this double arrowhead over here, right? So someone can say, okay, we're going to take an entry at this point, and we're going to put a stop below the previous candle, and then we're going to take a trade for price to continue moving up. But someone who's being very conservative, someone who's not really trusting the setup, or someone who's new, they might say, okay, you know what, I might want to wait for price, the next candle to break the high over here. As the next candle breaks the high, then I might want to take a buy for price to continue moving up. And for that, I may want to put my stop loss below the current candle. That's going to be the aggressive stop loss, right? So let's take a look at the next candle. Next candle goes bullish. Now, when you're having stop below the previous candle, this is a conservative stop loss, you know, but once you're taking an entry, once this candle is breaking the high, an aggressive stop is going to be below the current candle, you know, provided this is the 30-minute time frame or the 1-hour time frame. Sometimes what's going to happen is, now this is something really important to note, right? Sometimes what can happen is that maybe the high can be broken in the first 5 minutes of the 30-minute candle, or in the first 10 minutes of the 1-hour candle. Whenever that's happened, whenever a candle is breaking the high in the first 5 minutes or the 10 minutes of the 30-minute or the 1 hour, there's a very high chance it may retrace and come back down, right? It may retrace and come back down. There's a probability that does happen. That has happened to me as well. Because, you know, as sometimes what can happen is that candle can break the high, come back down to create a lower wick. That's why a conservative stop is always below the previous candle and not below the current candle, because that's very aggressive, you know. But now there's another thing to note is that if the second half of this candle is breaking the high, at that point, it's generally it's a good idea to bring the stop loss above the current below the current candle's low. You know, so I'm going to repeat that again. Whenever you have the second half of the candle, right, that's breaking the high of the previous candle, generally that's a great time to bring your stop below the current candle's low. You know, or when price is moving down and it's breaking the low of the previous candle, then you can bring the stop above the current candle right over there, right? So, or if it's the second half of the 30-minute candle. Yeah, exactly. You know, second half of the 30-minute candle, second half of the 1-hour candle. To really understand how to break down candles, you'll have to go through the unlearn and relearn section of candlesticks. You know, so there you can really, like, you know, learn about breaking down candles, or breaking down higher time frame candles to lower time frame candles. So we look at so let's say if we miss out on this trade, we look for the next trade. Next candle closes like a small body candle. And if you were already in this trade, I mean, we came up to this point. And now sometimes, you know, what people are going to say is that, hey, like, you know what, I'm going to have my take profit all the way up over here, right? But the thing is that whenever you have this range, let's say, so this is a range here, right? So whenever you have this range, it's not necessary that price is going to come all the way into this zone. It's not necessary. Price can come into this area. This is a whole area, right? Because price came up, rejected it. As price comes up, it may reject somewhere. So it's always a good idea to always secure profits. So whenever price is moving close to zone, you're always securing profits, and then you're letting the rest run. So now the next candle closed like a small body candle. Small body candles generally mean like there's less volume, right? So let's see what the next candle forms over here. Next candle still goes bullish. It still reaches up the zone. Now, it's not breaking the high over here, right? Now, if someone's going to say, okay, like, you know what? There's a lot of momentum. Price rejected this support. Big volume candle, small body candle, big rejection. This body is bigger than the previous body. And if the next candle breaks the high, I'm going to take a buy. That's going to be a really, really bad impulse entry trade. Man, you're going to get roasted. With that kind of trade, you're getting roasted 100% because we're at resistance. You have to wait for price to break and close above resistance. That's very important. Now, we approach resistance, next candle formed bearish candle, and then, we continue to move down. So now let's say if this was a higher time frame resistance, someone could say, okay, like, you know what? As we break below the low over here, maybe that's going to be a good point to, like, maybe have an impulse entry for price to continue down to this support right over here, right? Because look, okay, let's take a look at this example here too, right? Price came down to the support. This bearish candle came down to the support. It closed above the support, right? So taking a sell as the candle broke the low at this point, this is going to be extremely risky because we don't know whether this candle is going to continue moving down or it's going to come up to do a retest. We just don't know those things, right? So that becomes really risky. All right, so let's move on to the next example over here. Okay, so now you have candles that are basically consolidating, right? You have a lot of consolidation happening. I mean, you have this resistance formed at this point, and you're like, yeah, I don't know what's going to happen, and like, there's a lot of support forming over here, and this is just whatever, like it's pretty hard. There's no, like, I mean, even if you take a trade at this point, there's just not enough range at this point here. But we do know that if price breaks above this area, you have all this range for price to come up over here, right? So this is a big range to play in. This is a small range to play in. This is a very shit range here. So we're going to wait for next candles to form and let's see what happens. Next candle closes bullish. Now, next candle is closing bullish, and it's closing above that range. So when you have a candle breaking and closing above that range, there's no wick at the bottom. So when you have a bullish candle forming with no wick at the bottom, what does that mean? What does that mean when you have a candle closing bullish with no wick at the bottom? Yeah, strong bullish, very extremely bullish momentum. Good job. When a candle is closing bullish with no wick at the bottom, this means that there was so much bullish pressure that the candle didn't even attempt to come down to make a lower wick. It didn't even do that. It just went bullish, right? So now someone can look back and say, okay, like, you know what? Since I've been studying impulse entries and since I know this is gold or GJ, I know there's I'm going to be able to take a impulse entry as we break this high and keeping the stop below this breakout candle. This is also called the breakout candle, right? A breakout candle is a candle that does something that the previous candles couldn't do, right? Which is it broke out. So let's take a look at the next candle here. Awesome, right? So next candle, so as price breaks the high over here, you take a buy, right? You take a buy position, price goes into profits, price comes back down, it comes back down to your entry. Now, someone is going to say, okay, you know what? Someone who's not confident enough, you're probably going to put your stops at break even. As you go in profits, you're going to put your stops at break even, price is going to come down, stop you out, you're going to like, oh yeah, I took a trade and ended up at like break even, right? But someone who has experience watching the markets, they will say, okay, perfect. So I took an impulse entry as price broke above here. Price went in profits. As price started to come down to my entry point, this is what I do normally, right? If I don't get 10 pips and price comes back down to my entry point, what I'm doing at that point is I'm closing out some percentage of the position, right? Because the worst thing you want to do is to let the whole thing open and go in drawdown. What this means is that you went in profits, you had money in the hand, price came down, it took all the money that you had in hand, and now it's going back in drawdown. Now it's taking even more money, right? Now you're maybe losing what you shouldn't have lost. So whenever I go in profits and price comes back to my entry point, without me taking profits up over here, I'm closing 50%. because if price is going to come down to hit my stop loss right over here, I want it to stop me out at maybe 80% of my loss, 70% of my loss, but not 100%. I'm never letting price hit my 100% stop loss, never ever. So let's say we close percentage and we're still in a trade, or someone who's very conservative, they're like, okay, you know what, I'm just going to wait. I'm just going to wait for more confirmations, right? And the next candle comes down and breaks the low, and basically it is what it is. Impulse entries, it was risky, aggressive, didn't really work, and whatever, right? So now this was the first attempt at this trade, and now we're waiting for a second attempt at this trade, right? So now we have a candle closing bullish at the support again. Now what's happening right now is that now at this point we're not looking at this resistance here, right? Because we have a new resistance formed at this point. This is a really, really important concept. This over here to the left hand side, someone is saying bearish fake out. Guys, just keep your opinions to yourself. This is not a bearish fake out. Let me do the whole thing over here, right? So we're not. So this is basically called overthinking. When you're thinking about different things. So this is just overthinking. So looking left, we had this resistance, which we were looking at as price was breaking up over here, right? So as the next candle formed bearish, now this resistance does not matter here on the left-hand side. What matters is that price went up, created a high, came down at the support which we held previously, and candle closed bullish. Now this is a completely different setup than what we had right over here. Now we're not looking at this area, we're not looking at this area, not over here, not over here, not over here. We're only looking at this situation over here, that we had price went up, made a high, came down, created a support for price to continue moving bullish, right? So someone who's been conservative, they will say, okay, you know what? Maybe this range, maybe this range is not enough. So they will say, okay, you know what? I'm going to wait for price to maybe come up, and then I'm going to take a trade. So we're going to wait over here, right? Next candle comes up. It breaks the high of the previous candles. Now at this point, now if you're still looking for a trade, now you're going to say, okay, you know what? I'm going to wait for price to break the high over here. And as you wait for the price to break the high over here, your stop is going to be way too big, right? Because if you enter at this point, your stop is going to be way down right over here. So it's going to be a bad trade because the stop is going to be pretty big. So now you're waiting for the next candle to form here as well. Next candle forms a bearish candle. Now this is the point where you're looking to see that, okay, like, you know what? We came up to the high, price came over here, closed bullish, couldn't take a buy because the stop would have been way too big. And now we have a bearish candle forming. Now when you have a bearish candle forming, this means a resistance is being formed. Now you have two options, right? Actually, you have two options. The first option is that as the next candle breaks the high of the bearish candle, you can take an impulse entry for price to continue moving up to fill this wick and eventually come up to fill right over here. Or you can wait for the next candle to close bullish and then take a buy with more confirmation, right? So now you can see how impulse entries gets a little bit risky, right? Because now you're entering before the confirmation. So let's take a look what happens here. Awesome, right? So let's say that you executed a buy at this point and your stop loss was below the candle right over here, which was breaking the high. So now you're in trade. Now you're in a trade, and basically at this point, impulse entries work well because even though you have this confirmation candle forming and you were waiting for a candle to form, like a small candle to take a trade, now you can't take a trade with confirmation because now your stop is going to be bigger, right? If you're entering at this point, your stop is going to be way down over here. But if you really understood impulse entries and you waited for impulse entries, you have a lot of experience with impulse entries, your entries were right over here, your stop was smaller at this point, right? This is where impulse entries are really, really good. So now we're expecting the next candle to move up. Perfect, awesome. Next candle moving up. It's closing with no wick at the top, which means there's a 50-50 chance that the next candle can continue moving bullish. Let's take a look at the next candle. Next candle closed bearish. We have a bullish close over here, and next candle moves up and kind of like does its dance and whatever, right? So a great impulse entry was at this point right over here. right? This was like whatever first chance we gave to the trade, and then this was the second chance we gave to the same bias to continue going up, right? Um, let's take a look at the next example over here. All right, so we have a candle that's closing bearish, right? It's breaking the low of the previous candle. Is this a good opportunity to take a sell? Do we think that the next candle can continue moving bearish, or we need more confirmations? Oh, someone said yes. Okay. Well, taking a sell first, the stop is going to be way too big, right? It's going to be a bigger stop loss. So I don't think that could be a very good idea there. It's better to wait for another confirmation here. So we have a candle closing bearish, a small body candle at the same wicks. Now the problem with taking a sell is because, okay, let's go back here, right? Let's go back here. The problem with taking sells is that this is an entire area where candles have came down and wicked out of it. You know, so let's say that we did not have, this candle, we did not have this candle, and we did not have this candle right over here, right? Let's say we didn't have these candles here. So when this candle was forming, right, we had this candle coming down. So someone can say, okay, you know what? We can continue moving down, you know, but we can continue moving down only till this wick right over here. This is, if price is going to continue down, the most probable point where price will continue down is going to be a wick fill, right? And this is going to be the wick fill right here. This is not enough range for price to continue down because price came down, it rejected it. So if the next candle comes down to this area, there's a very high probability that price will come down, look left at this wick and say, yeah, you know what, my buddies on the 1 hour and 30 minute, they rejected that area. So there's a very high probability we can reject that area as well. You know, so look, next candle came down to this wick, kind of filled it and then rejected it. You know, so now we know that, okay, this is a wick rejection, price rejection area where price is most likely to create like some sort of rejections there, right? So let's wait for next candle. Next candle comes down, it breaks the low. Now, the problem with impulse entries, this is the problem that becomes with impulse entries, right? As we're breaking the low over here, people are going to take a sell. You know, you're going to take a sell as price is breaking the low without closing below the low. As you're taking the sell, price just retraces and you're like, oh my God. You know, price is retraced and I took a perfect entry, but in the opposite position, you know, like in the opposite direction. So now we know this is a rejection area, right? Next candle forms bearish. Now someone said that we can take a sell at this point, but there's not enough range. You know, even if the next candle comes down, it's going to come down to this area here. It's just going to, like, you know, wick up. There's a higher probability price is going to wick up. There's a low probability that the next candle will continue moving down, right? It's all about probabilities. You know, higher probability price will wick up, low probability price will break down. So do you want to take a low probability sell, or do you want to wait for something that's going to have a higher probability of winning? That's some things you want to ask yourself, right? So we're waiting, candle close like a weak bearish candle, nothing really happening over here, sort of like creating a resistance at this point too. So if we're doing some chart analysis here, we're forming some sort of a resistance at this point. Okay, let me just color this a much better color over here. Oh, maybe remove it. Pick a blue color and yeah, perfect. So we're forming some sort of resistance over here. We also have some sort of resistance forming right over here, right? So now we're waiting for some sort of a confirmation at this point. So we wait for the next candle close like a bullish candle. There's still not enough range. There's no trade to take. I mean, it's pretty difficult at this point, right? Let's wait for the next candle over here. Next candle closes bullish. Now, this candle is breaking above the highs of these candles right over here. Now, someone who's looking at the, so let's say this is the 30-minute time frame. If this is a 30-minute time frame and the 1 hour time frame, what you have is a 1 hour range going all the way up over here. But at the same time, what you have is maybe a minor 15-minute range right over here, right? And someone can turn around and say, oh yeah, man, but we have this minor range over here. And then, so aren't you scared of that range? And someone with experience, someone like, let's say, Luke, someone, let's say Luke, or invest in yen, can say, oh, no. Since that's a minor time frame resistance, we're looking at the higher time frame confirmation. Because if price is rejecting a higher time frame support, it will break a smaller time frame resistance. Because now we're looking at the higher time frame range over here. So that basically is not going to matter. So someone can say, okay, you know what? I may want to take a trade as the candle breaks the high of the previous candle to continue moving up. As you break the high, you're placing the stops down over here. Now, if the stops are going to be bigger, obviously you're reducing the risk at that point. But if, let's say, your stops were bigger and you don't want to reduce the risk and you want to wait for something much better, then you're waiting for a smaller body candle giving you that confirmation that, okay, we are continuing to move up. So as the candle starts to break the high, this is where you're taking impulse entries and keeping the stops below the previous candle. So sometimes, when you're looking at high volume pairs will not do retests, because if we're breaking above this area, someone can turn around and say, okay, you know what? I'm going to wait for a retest, for price to continue down, to retest, and then go up. But someone with experience, someone who's watched GJ or gold for a long time, they will understand that, hey, like, you know what? If candles on a 30-minute time frame and a 1-hour time frame are making higher highs and higher lows, there's a very high chance they will continue making higher highs and higher lows to probably fill the range. Now as we come up to this point, we don't know whether price is going to come all the way up over here or it will reject. Oh, it looks like it's rejecting there, right? So it's really important you put your trust in the candles to continue making higher highs and higher lows. Right, so next candle closes bullish, it breaks the high over here. Now once this candle is closing bullish, is this a good area to take a buy? This is not a good area to take a buy because there's no range. There's very less range, even though we see a lot of momentum here. Even though we see this candle is closing above the previous two candles, there's a lot of volume. This is, let's say, NY open. We have a range over here. It's just going to get really risky, right? So this is where people get stuck at this point because, they will see that, okay, so if you're taking a trade based on this point, you're basically telling to yourself that, okay, you know what? I'm ignoring this move coming up. Because if you had this move and you missed this move, man, this was a trade. Thinking about a trade at this point, it's just not going to make any sense. So even if you do take a trade here, putting a stops below the current candle, and the next candle closes bearish, sometimes guys are still going to stay in the trade, even though the candle is closing bearish on the 30-minute or the 1 hour. That's going to be the point where you're just closing your entire trade. Because once the candles are closing side by side, that means price is consolidating. And if you've missed this move up, you have to open up your phone, you have to turn the camera to look at you like in a selfie mode, and you got to tell yourself that, hey man, you missed out on the trade. That's it. You missed out on the trade. Because this was a trade coming up. This is just like now you're trying to catch a move that you missed. So let's take a look at the, so let's move on to the next section right over here, right? Let's move on to the next section here. Impulse entries during consolidation, right? Impulse entries happen in only two ways. Once price is trending, we talked about trending, and now we're going to talk about consolidation. When price is consolidating. When price is consolidating, it's really, really, really difficult to take an impulse entry. Really, really hard. So there are a few things to monitor over here. This is the most dangerous type of adventure you can take your trading account on. And I've seen people do this a lot of times, man. Price is going to consolidate, and as the candles are going to start to break the low or the support, they will take a sell, and price will just come back up and back in the range. So that's a very dangerous adventure, man. I mean, if someone's trying to go on those adventures, good luck. They basically, I mean, I've had very little luck on that, so I don't really bother with that either way. During consolidations, most times, price may seem like it's breaking the lows at the highs to continue bearish or bullish respectively. Sometimes when price is consolidating, it may move in such a way that you may think that it's breaking the high. And that happens a lot of times, that when you think that price is breaking the high, you start trading based on what you think. not based on what you see, because what you're seeing is that price is breaking consolidation, but you want it to break and close above consolidation. Even if that means you're going to miss the trade, be prepared to miss the trade. It's totally okay to miss a trade. A lot of people take that as a negative. Don't take that as a negative if you're missing a trade. That's totally fine, because whenever you miss a trade, that means you did not expect price to move the way it did. Right? And that's a lesson for you to learn, that, okay, if you missed a trade, then you can look back and say that, okay, how could I have been in that trade? And most times when price moves with no retests, with no candle closes, and you just see one big giant candle moving, it is what it is. It's basically you just had to miss that trade. It will most always likely to pull back in the range. Whenever you're trying to take a trade in consolidation, most likely it will pull back in the range. You have to wait for a candle to close outside of the range on the 30-minute or on the 1 hour. Really, really, really important. This is what we saw in the example right over here, right? You have to wait for price to close above the consolidation, and then you're putting your trust in the candles to continue making higher highs and higher lows. You're putting your trust in it, because sometimes there will be no retests. Okay, at times the candles do not close and they continue pushing. It is what it is. With experience, you can count on the smaller time frames, 15-minute and sometimes 5-minute, to close and continue momentum, right? Sometimes when you're missing moves on the 30-minute or on the 1 hour, let's say on the 1 hour, right? On the 1 hour, you see that, let's say you have a resistance here and you have a support over here, and you have a 1 hour candle that's basically breaking the lows like this, right? And it's forming, and you're like, okay, it's going to close, and it keeps forming. You're waiting for a close, and it's retracing, and you're waiting for the close, and candle keeps falling and falling, and it keeps falling down. Let's say if this is the 1 hour candle, you see that keeps falling down. This happens mostly in GPJPY and gold, right? And once you're seeing this happen on the 1 hour time frame, you're like, oh man, I missed the move. Like, I don't know what to do. Like, there was no confirmations. There was nothing for me to take a trade. With experience, what you can do is now you can break this candle down on the 15-minute or on the 5-minute, because on the 15 and the 5-minute, you might see some sort of, like formations like this. You might see some retracements at the same time, some retracements like this, and you might see continuations like this. This reading market structure on the 15-minute and the 5-minute, this comes with experience, So I used to miss these big candle moves all the time right over here. All the time I was missing these big candles moves, and then I started to look at the smaller time frames to see that, okay, I'm missing these big candle moves. How could I have taken a trade looking at the smaller time frames? Looking at small time frames, it is an advanced concept. It's risky as well, because what can happen is sometimes what guys are going to do is they will say, oh, like, okay, if this is a 5-minute time frame or a 15-minute time frame, well, this will be my confirmation candle, and I'm going to take a sell over here, and I'm going to keep my stop above this candle. What can happen is that your selling candle, this one here, it can come up and break the high of the previous candle and then continue moving down. That can happen as well, because that's a smaller time frame, and small time frames are weak confirmation time frames. So, like, it can break the high. On smaller time frames, price moves like, okay, so let's do this, right? On higher time frames, if price is moving down, it's going to move like this. It's going to make clean lower lows and lower highs, right? But if you're looking at the smaller time frames can move in downtrend like this. Make a low, make a lower high, make a lower low, come up to break the lower high, and then continue making a lower low. This is how on the smaller time frame price can move sometimes. So it becomes more risky, which is why we only put our trust on the higher time frame, which is like, clean trends, lower time frames, choppy trends. That's why we're always putting our stops above the 30-minute or the 1 hour, 15-minute, 5-minute, very risky, because candles can actually betray you and break the highs and the lows. Alexander said it takes a lot of experience and a lot of time watching moves happening. Oh, yes. Absolutely, man. It takes months. Trust me, it takes months. If you see a certain setup, and if you miss that setup, and if you think that setup is going to happen tomorrow, no, man, that setup may happen next week. And now your experience in watching that setup, it may take a couple of months, because that same setup may not happen for another week. It may not happen for another 2 weeks. So then you're waiting for it to happen again after a week, and then after 2 weeks again, then after a month again. So you're spending months in looking for that setup and then building experience, you know. So trading is a marathon. I used to think it's a race, you know, like Ted used to tell me, hey man, trading is a marathon, takes time. And I used to think, no, man, it's a sprint. The more you make, the faster, the better it is. But quickly I learned that's not the case. You know, it's actually a marathon. So he was right and I was wrong. Okay. This is extremely risky. As you are trying to sell a low or buying a high, there's a very high chance that price can pull back to do a retest before continuing, right? So as price is consolidating and as it's breaking the low or the high and you're trying to take a trade, it's extremely, extremely risky. So you always have to wait for price to break or close above the high or the low. So let's take a look at a few examples here on consolidation, right? So awesome. So we have price consolidating at this point. Very difficult. We don't know what's happening. It's extremely difficult to read. But what we do see is, like, let's say this is the 30-minute time frame, right? And on the 30-minute time frame, let's say we have our most recent resistance over here. We have our most recent support right down over here. So price is ranging in this area. So whenever price is ranging, we're expecting volume to come into the market. So whenever there's going to be volume coming into the market, someone can look back and say, well, what about this support right over here? So what's happening is that if price is ranging for, let's say this is the 1 hour time frame, right? Let's say price is ranging for 1, 2, 3, 4, 5, 6 hours. 6 hours we have range. So whenever there's going to be a break, we're anticipating price to not only break out of this range, but also once it breaks out, we're expecting it to, actually, let me just remove these arrows here. We're expecting it to break above over here or break below at this point here as well. So we're waiting for price to close at this point to see what happens. So next candle forms. Next candle kind of like forms like whatever, like a weird candle. Doesn't make any sense at all. We're still ranging. We're waiting for the next candle to form. Next candle closes bearish, right? Next candle is closing bearish with no wick at the top. Whenever you have a bearish candle closing with no wick on the top, this means that there was no bullish momentum in this candle at all. So candle closed bearish. So whenever a candle is closing bearish at this point, if you're taking a sell at this point, you're keeping your stop above this breakout candle. You know, if you're keeping the stop above the breakout candle, you're basically you're using your lower risk. You're not going in with your complete risk because now you're taking a trade at this point, but we're also coming down to the support and you're anticipating price to continue moving bearish. Right, so let's take a look at the next chart over here. So right, perfect. So next candle comes down, it breaks the low over here, continues moving down. We look at the next candle continues breaking this area below as well, right? So if you were looking for impulse entry, a good impulse entry could have been at this point right over here, you know, with you keeping the stop above this candle at this point. Because if we are ranging, now this is really, now someone can say, okay, well, we're approaching the support. That's true, we're approaching the support. But at the same time, we have to understand consolidation. Price is consolidation for 6 hours. So the longer the price consolidates, the harder the price breaks, right? So whenever we have a candle like, you know, breaking below that area right over here, now you're anticipating the next candles to continue moving bearish. And this is your impulse entry right over here. Whenever breaking the low, your stops are going above the current candle right at this point. You know, and then you're just trusting that the candles are going to continue making lower highs and lower lows. And, you know, price starts to continue moving down. And then we have this bullish candle come up and whatever the case is, right? But let's say, for example, let's say you did enter a trade, right? Let's say you did enter a trade at this break of the low right over here, and you put your stops right over here. What if the next candle starts retracing, right? If the next, so let's say this is the 30-minute time frame. 30-minute candle broke the low, you took a sell, and what if the next 15-minute candle, it closes bullish? At that point, you're reducing your risk. Because if a 15-minute candle is closing bullish at a minor support, at this point right over here, you have 15-minute candle closing bullish. Now you're being more cautious of the trade, right? Because if the 15-minute candle can close bullish at this minor support, that may give probability for the next 15-minute candle to close bullish, ultimately making the 30-minute candle close bullish as well. So you're reducing risk at that point. You're saying, okay, you know what? 15-minute candle is closing bullish. I'm going to sell. I took an impulse entry. I may want to be careful here a little bit. So you're reducing risk at that point, saying that, hey, you know what? I'm not comfortable risking what I'm risking right now. So I'm just going to wait and reduce risk. So it's all about putting your trust that the candles are going to continue making lower highs and lower lows, right? And then, price did whatever it had to do, and like it started to continue down later on, whatever. Let's take a look at the next example over here. All right, perfect. So we have price basically came down and it's consolidating, right? We have support down over here and we have a resistance up over here. I mean, it's basically a very, very, very tight consolidation, right? This is what we call the classic goat shit. This is a goat shit confirmation right over here. So we're waiting for price to either break above the high or break below the low because, price is ranging. We have this candle. It broke the high. Someone's going to say, okay, you know what? I'm going to take a buy. So when you take a buy as it's breaking the high out of consolidation, price moved up, and then it can come back down over here and close right within that range. So that's going to be a very, very bad idea to take an impulse entry. So whenever price is consolidating, you're waiting for a strong bullish candle to close, or you're waiting for a strong bearish candle to close either bearish or a strong bullish candle to close bullish for price to go up because you have clean candles here, right? So at this point, we're just waiting. See this right over here? This candle, it broke below the low, and once price, now before this webinar, if someone saw this as consolidation, price started to break the low, they'd be taking a sell. They'd be like, okay, we're consolidating, but now we're breaking below the low. Oh my God, price is going to drop down. Let's take a sell. You take a sell, price goes in profits and closes back in the range, and now you feel like a dumbass. So this basically happens during Asian session when there's a lot of range, before news happens, something like that. So it becomes very, very risky. So let's wait for the next candle here. Next candle actually closes above this consolidation here. And now you're looking to see that, okay, you know what? Perfect. Now, two things can happen at this point. What can happen is that the next candle can come down to do a retest to continue moving up, right? Or the next candle can break the high, and as it breaks the high, you can take a buy having the stop below the current candle. Or what you can do is that you can have a buy entry over here, keeping the stop below this candle. Now, keeping the stop below this candle by taking a buy at this point and having the stop below this candle right over here, that's going to be a bigger stop loss, right? So you may want to have to reduce your risk at that point because that's going to be a bigger stop loss, and you're going to be like, yeah, you know what, I don't know. Or a much safer idea, this is where impulse entries are going to come in handy. Or you can say, okay, you know what, as the next candle starts to break the high, I may want to have my stop below the current candle. So let's see how the next candle forms. Next candle forms bullish. Okay, perfect, right? So you can have a stop right below. Well, it broke the high, your stop is right over there, and it closed like a bullish candle. So let's say if we're in buys at this point, right? What are we thinking? If we are in a buy at this point, and the candle closed like this. Tricky, right? It's very tricky. Someone's saying it's going to fly. Someone's saying, perfect. Someone said volume for buy is decreasing, right? Because once you're in a trade, you're expecting candles to form a certain way. You're expecting candles to continue bullish. So if this is a 30-minute time frame, let's just take a look at this candle right over here, right? If this is a 30-minute time frame, and if we break this down on the 15-minute, the 15-minute may look something like this, right? So we had a bearish candle on the 15-minute, and then we had a bullish candle forming like this. This is what the 15-minute candle looks like on the 30-minute right over here. The candle came down, 15-minute candle closed bearish. Maybe that was the point where you were reducing some risk, taking some positions off, and the next 15-minute candle closed bullish. So either now you're saying that, okay, Since 15-minute candle closing bullish, the next one has a probability to continue going up. But once you look at the 30-minute, you're like, yeah, you know what? The 30-minute candle is closing like a weak bullish candle. So even though we have a rejection over here, we're not really sure if it's going to go up or not. So I might want to be a little bit conservative with my trade here and removing some stops, right? So let's take a look at what happens with the next candle here. Next candle forms bearish, and you're like, okay, you know what? Maybe I just want to close my trade because, you know, it is what it is. Next candle closed like a weak bullish candle, and it's just garbage at that point. You know, so sometimes we can have a really good opportunity to take a trade, but then very quickly something like this can happen, and then at this point, you shouldn't be holding a trade, because once you see candles not doing what you want them to do, it's better to just close out the trade and wait for a better confirmation, right? Better confirmations are like, it's much better. Now, let's say that we did, okay, so let's say we only had this candle right over here, right? And the next candle formed. This is also going to be a very dangerous place, because sometimes what can happen is that you can basically convince yourself by saying that, okay, we had this candle bullish, we had bearish candle, it came down to the same support area. We had candle closing with a small body here, small body bullish candle, not enough confirmation for buys. Next bullish candle, small body, not enough confirmation for buys. Next candle, small bearish candle, nothing. But when this candle breaks the high of the previous bearish candle, someone may want to take a buy over here for price to continue up. The reason why it's going to be bad, because this candle hasn't closed yet. This candle's still open, and we don't know, even if it's breaking the high, we don't know if it's going to, wick down, close like a small body, or continue up to close like a strong body. We don't know that. So that's why we're always waiting. So let's move on to the next example here. And this is going to be our last example here for the day. Oh, we're already like an hour and a half in. Time went by fast. Wow. Okay. All right. So again, we have some situation happening over here. Price is creating a resistance at this point. So let's draw our resistance over here. Price is creating resistance. And maybe this is support. It's just kind of tricky here, right? So let's take a look at this chart over here. Oh, okay. So we have price moving up over here. Now, taking a buy at this area here would have been extremely risky. Why? Because we are at resistance, and we don't know whether candle is going to continue up or it's going to come back to create a wick. But these things do happen. When these things happen, you're like, oh, okay, you know what? I basically missed the trade. But with experience, as you're looking at the charts for a long time, GPJPY or gold or your JPY, sometimes GBP USD as well, and as you see candles breaking the highs, you're like, okay, you know what? Maybe I may want to risk something to get that breakout. That comes by watching these things happen over and over and over again. It's not easy. This is very difficult. So let's say, we were very conservative and we missed this trade and price moved up. We're like, okay, you know what? We missed this trade. Let's just wait for the next candle to form, and let's see what happens. So waiting for the next candle to form. Next candle closes bearish. Now it may come down to do a retest to take a buy, and next candle is coming bearish here again, right? Now, this is the point where we want a candle to close bullish so that we can take a buy for a candle to continue moving up, right? So now at this point, we're looking at two situations, right? What are the two situations we're looking at this point? What are the two situations if price breaks the previous candle high? Okay, makes sense. We can take a buy. Support or fake out, perfect. Jody, this R comes back to the range. That's perfectly what we're looking at, right? So this was resistance, price broke up, price rejected this 1, 2, 3, 4 over here. This candle, now the next candle, we want the next candle to do like a retest to continue moving up, or to break the high so we can take an impulse entry to continue moving bullish. But if the next candle comes back in the range, then this move up becomes a fake out. So whenever we have a fake out, there's a very high probability that price will continue down to the opposite range and it may continue moving bearish, right? So let's wait for next candle. Next candle comes back in the range. Now this is where you're looking to see that, okay, like, you know what? Now either price is going to do a retest of this area to continue down, or it may just keep breaking the lows and continue moving bearish. So when price keeps breaking the lows, that's where you're anticipating price to do, like, you know, impulse entries. You know, price moves down, breaks the low. Maybe this is the point where you're entering a sell and having a stop above the previous candle, anticipating price to not only come down to the support, but break the support and continue moving down. The reason why we're kind of ignoring the support, because there's a 70% chance that price will break the support after doing a fake out. If someone doesn't know what fake outs are, we have a whole webinar in the database on fake outs. So you'll have to watch that, you know. And as price now breaks the support, now let's say if someone was conservative and they're like, okay, yeah, you know what, I'm going to wait for price to break the support and then I'm going to try to take a sell. You know, now once price is breaking down over here, now you're saying that, okay, maybe I want to take a sell as price breaks this low over here. Now, the problem with price breaking the low here is that price may retrace to do a retest to continue moving down. There's a probability that might happen, but there's also a probability that as we break this low and you keep the stop above the current candle, which is going to form something like this, right? So let's say you were taking a sell at this point, and then you kept your stop above the current candle and anticipated next candle to go down, it may just continue doing lower highs and lower lows, right? But if we look at this candle, let's say if we look at this candle, and if we break this down on the 15-minute time frame, or maybe on the 5-minute time frame, it may look something like this. Let's say this was a support, you know, candle came down, next candle also came down, you know, and formed something like this, and then we had the next candle closing like a bullish candle like this, next candle also closed bullish like this, and then we had the candles after that, they created like a minor resistance to eventually continue moving bearish at this point, right? So if we're looking at this 30-minute candle right over here, on the smaller time frames, it may have a structure like this, right? So sometimes whenever you're missing a move like this, waiting for a retest, let's say if someone missed this move, right? And then you look on the smaller time frames, you're like, oh, okay, you know what? Smaller time frames and this right over here, this just makes total sense, you know, and you may have to miss this moves a bunch of times to really understand the concept. You know, understanding concepts, it takes time. You know, it takes understanding concepts also means that you're missing out on moves. So whenever you're missing out on moves, that's an opportunity for you to learn or to understand a concept. You know, so you're taking a trade based on the low of this low over here, keeping the stops above here. As this candle is closing bearish, you're like, okay, there's a high probability for the next candle to continue making lower highs and lower lows if this is the 30-minute time frame or the 1-hour time frame. You know, but on small time frames, it's always doing some retests and whatnot. And the next candles just continue moving bearish. So this was the end of our impulse entries section over here. In November, we're going to do another big webinar, and that's going to be the end of year webinar where everything is going to be discussed again. I think we're going to have some more information in that there too. But if anyone has any questions, you know, based on that, we're open to answer any questions. If not, this is Sunday. I thought it was a Saturday. No, I thought this was I thought this was Saturday. It's Sunday. Okay, perfect. So this was actually recorded. Oh, okay, we have a question over here. Question is, when candles close with no wick in your direction, let's say before you hit 10 pips in profit, will you close partials? If a candle closes, yes, so I'm going to close partials at that point. Whenever a candle is closing with no wick in my direction and I hit 10 pips, I'm going to close obviously 10 pips, you know, secure positions at this point. So this was actually recorded. The recording is going to be in the database in a couple of hours there. I'm also going to announce it in the group. And then we can go from there. Okay, what's this? You said you put more weight on the break of the high time frame confirmation. So like we can abuse our position size a bit more. Abuse means like what? You got to use simple language. I don't know what that means. I think abuse means, oh, higher risk? No. Why? No, you shouldn't. That means you're being greedy. You know, plus also this requires a lot of experience too. So there is not any impulse entry that shows full of confidence. No. Impulse entries are basically risky entries. You know, impulse entries takes a lot of experience. Impulse entries, they require a lot of back testing, like a lot of waiting around and watching and stuff like that. You know, so impulse entries, they're all means like it's based on low confidence, and also when you're taking impulse entries, you're basically taking impulse entries without confirmation. So that's why they're very risky. Can you show a confident entry setup? This one was right over here, confident entry setup. Confident entry setups, you need to look at the candle trends section in unlearn and relearn section. How many impulse entries do you find yourself in average per week? Maybe 2, maybe 1 or 2. Does it make sense to put stop from conservative to aggressive stop loss once the price breaks the higher low around 3 pips without waiting for 15 minutes to close first? No, you have to wait for candles to close. You have to wait for candles to close. It doesn't make sense to move your stop loss unless you haven't secured positions. The only moment you should be moving your stops is if you have secured positions. That's the only reason you should be moving your stop losses. So take care, everyone. Have a good Sunday, and we will see you tomorrow morning, New York session. Take care, everybody. All right, welcome to so this webinar. In this webinar, we will cover impulse entries, when and where to take impulse entries. I know in the past, like a lot of people have struggled with impulse entries, and the reason why is because impulse entries are a advanced topic. You know, I think if someone's new, it'll be better to go through the unlearn and relearn section and go over the risk management sections. It's a 2.0 and 3.0, so that you can kind of like understand what we will talk about here. So, actually, let me turn on this thing over here. No, we just leave it off. All right, perfect. Let's check this out. Okay, so what are basically impulse entries? What do we mean when someone says impulse entries? Let me remove this here so the webinar is recorded. All right, so basically, these entries are when we are expecting price to continue moving either bullish or bearish after it breaks the high or the low of a previous candle, right? The very simplest way to explain impulse entries is, okay, so I'm just gonna answer, I'm gonna make one statement here. Please don't ask any questions. I'm not going to answer any questions during this webinar. Questions will be answered at the end of the webinar. So please leave the questions to yourself. If you have questions, write them down or say it out loud in your head, but please don't write the questions in the chat. It distracts me from, the mission here today. So, okay, let me just turn off my WhatsApp sound here as well. Some people get confused. They're like, oh, it's our WhatsApp or his WhatsApp? All right, here we go. Did that. I think Conrad wants to be kicked, so we will disable participant notifications here. Disable annotations for everyone. All right, perfect, right? So basically, let's say we have a support area down over here, and let's say you have a candle that's closing bullish in this area right over here, right? And impulse entry, what we mean by impulse entries are basically when the next candle is breaking the high of the previous candle right over here. This is what they mean by impulse entries, right? When we're breaking the highs, because the whole idea is, now, if we understand trend, right? A trend is something that makes a higher high, makes a higher low, makes another higher, and makes a higher low, right? So basically what you can do is you can enter a buy in a trending market in two ways. The first way is going to be that you will wait for a price to create a high, price will come down, it will create a support, you will see confirmations of support, and then you will take a buy and price will go up. We all know this, very simple, right? The other way is that when price is breaking the previous high right over here, right? When price is breaking the previous high, then someone can say, okay, you know what, it's breaking the high. That means there's a high probability for price to continue moving up. But what's happening in this case is that, let's say you waited for support to form down over here, so your stop loss was down at this level. But if you're entering up over here, once we're breaking the previous high, you still have the same stop loss, right? So essentially what's happening is your stop loss is bigger in an impulse entry because it's below the previous low or it's below the previous candle. But when you're waiting for a candle to close at support, your stop loss is smaller. So when we talk about the impulse entry right over here, as you see this candle breaking the high of the previous candle, then someone can say, okay, you know what, I'm going to take an impulse entry because now I think price has a high probability to continue moving up. That's the basics of impulse entries, right? At the same time, again, your stop loss is still going to be bigger right over here. So if you're entering at the point where candle is closing, you're going to have a smaller stop. But if you're entering at the break of the previous high, then your stop is going to be a little bit bigger. So that's something you have to keep in mind. Let's remove this here. Ooh, got too many arrows. All right, when should we look for impulse entries? This is the most important part right over here. There are two ways: when there's a very, very high volume or when the market is trending, right? Impulse entries, whenever you're taking impulse entries, you're expecting price to continue moving forward, right? Let's say if you have a resistance right here, you have a support down over here, you have a candle closing above resistance right here, and let's say if someone says, hey, like, you know what, I'm going to take an impulse entry above the high of the previous candle, you're basically anticipating price to continue moving bullish, right? That's the whole idea behind impulse entries, because whenever there's high volume, right? So now we have to ask ourselves, what are the times in the market when there's going to be high volume, right? We all know there's going to be high volume in New York Open, there's going to be high volume in pre-New York, NYC Open, London Close, sometimes New York Close, Asian Open, pre-London, London Open. So these are the times when there's going to be high volume in the market. Other times are when there's going to be news, there's going to be a lot of high volume in news. All this is covered in the Unlearn and Relearn section, right? So it's really important to know the times when there's going to be high volume so that your impulse entries can work out. Another time is going to be whenever there's news, right? Whenever you have high volatile news events. Now, what happens in news events is that price is most likely to break the highs and the lows of the previous candles, which is why, sometimes people use buy stops and sell stops. Buy stops and sell stops are kind of like the same as impulse entries because you're expecting price to just continue moving without stopping. All right. Another way is in a trending market. Whenever price is trending, right? Because we all know that let's say we have a trend and market is trending, let's say bearish. We have a bearish trend, price is coming down, and then like price creates some sort of a support and it starts to move up a little bit, and then it forms some sort of a resistance right over here. We have a resistance formed, and the next candles are now starting to continue down, right? So the impulse entries are going to be when the previous candles are breaking the lows of the candles. Because once the candle is breaking the low of the previous candle, let's say right over here, you're anticipating price to continue moving down. Because what happens in a trend is like if price is going to continue down, it's going to make lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So once this candle is breaking the low of the previous candle and respecting the high, then you're kind of like anticipating that, okay, now there's a higher probability for this current candle to continue moving down to make a lower low, right? So it's all about trust. You're putting your trust into the candles when they're trending, right? You're trusting the candles to continue making lower highs and lower lows without breaking the previous candle's high. That's something which you're really, really focusing on. Because if for some reason this candle starts flipping bullish and starts breaking the high of the previous candle, let's say right over here, right? If price starts to come up to break the previous high, then you can say, okay, you know what? Maybe the probability of price going down is less. So whenever candles are open and they're breaking the lows of the previous candles, that's where you're taking an impulse entry, anticipating price to continue moving bearish. Now, mind you, right, this is also very, very risky because what can happen is as price is breaking the low, it can very well break the low and then continue moving up, right? So they're extremely, extremely risky. You have to see this happen, I'd say like 20, 25 times so that you can create your own bias, that you can say, okay, like, you know what, I've seen it happen a couple of times and it has worked most of the time, so now I may want to execute on this. So if someone would go ahead and work with impulse entries, I'd say the best idea would be to go with lower risk or paper trade it, because sometimes when we're trading a pair like GPJPY or EURJPY or gold, we know that those pairs sometimes they don't do retests, so you're forced to enter with impulse entries, right? And all of that comes with experience and how many times you've seen that happen before. When is the risk? Okay, we're missing a point over here. What is the risk factor with impulse entries? Impulse entries are really risky as entries are taken before the candles close, right? Now, contrary to popular belief, we always say that, hey, like, always wait for candles to close, because when you can wait for candles to close, then you can get a better idea on where the next candle is going to go, right? In the complexity of things, I think if we move a step higher, we will understand that, okay, when we're not waiting for candles to close, we're basically executing before the candles are closing and they're breaking the highs and the lows, right? That's why these are risky entries, because you're entering before the candles close. When not to look for impulse entries, whenever price is ranging or consolidating. So we're going to talk about these here in a bit too. Whenever price is ranging, right, we don't know whether candles are breaking out. That's just a fact. And whenever we see a range, we see wicks moving up and down of the candles, right? So that's why you really, really have to focus on to see when price is not ranging, or even during a counter trend trade, unless we break a zone. So, okay, so we're going to talk about this here as well. So let's see here. When are impulse entries invalid? Ranging market, whenever there's low volume. Whenever price is ranging, it's better to wait for a candle to break and close above the range or below the range. From a risk perspective, this is important, especially knowing that the price can continue moving, in the opposite direction. So let's say, for example, we have a support down over here and we have a resistance up over here, right? Let me use a better color here, or let's see here. Okay, let's use a blue color right over here. So let's say you have a candle which is moving bearish, right? It kind of like wick down, didn't really break the low, and then you have another candle that moves up. So right now we're in a range. Right now there's no trade at this point. And then you have another candle that kind of like wicks above, and then it closes like this, right? And now you're seeing, okay, the candle's kind of like wicking above. It isn't closing above, it's just wicking above. And then you get another candle that goes bearish, and we're like kind of like ranging within this range at this point. So when this candle is coming down and you look to the left hand side, even though this candle is closing below the previous candle, it's still in this wick zone, right? You see this wick zone? It's still in this wick zone. What this basically wick zone here means that this candle, it came down to this price and then it rejected it, right? So when the next candle is coming down to the same area, there's a very high probability it's going to reject it as well. Because whenever you see candles are always looking left to see what their friends did, right? So when this candle is looking left, it sees that, okay, this candle here, it came down to this price area and it rejected it. So what are the odds that this candle is going to reject here again as well? The odds, they're pretty high because we're rejecting this area. Now, taking an entry at this candle would be very, very risky. A better impulse entry, it could be that when the next candle starts breaking the low of this candle, when this start breaking the low, then you can say, okay, you know what, there's a high probability for price to continue moving down. But for some reason, what also happens is that the candle is going to break the low, and what's going to happen is it's going to start moving the opposite way. Right? This is where your risk management comes into play. If you have a good grip on risk management 2.0, risk management 3.0, and if you entered a sell as the candle was breaking the low right over here, then you can kind of like acknowledge that and say, okay, I entered a sell, price went in like 1 pip, 2 pip profit, and now we're retracing back. So as candles are retracing back, let's say, for example, this is a 30-minute time frame, and as candles are retracing back, you're looking at the 15-minute, you're looking at the 5-minute, and basically you're looking to see that, okay, are candles really closing bullish? Because for price to continue moving bearish, you need candles to close in your direction. You need the 5-minute to be in a direction, the 15-minute, 30-minute, 1 hour, the whole 9 yards, right? But even if you see smaller candles closing against you, that might give you an idea that, hey, you know what? I entered an impulse entry right here, and I understand that impulse entries are risky. And I also see the 5-minute and 15-minute, they're closing against me. Maybe this is the time where I should manage my risk. Maybe I should just close 50% or close 70%, and let's just use like a lower risk, because I expected candles to continue moving down, but they're going against me. So it makes no sense to hold that trade. So that's how you're kind of like mitigating your risk in impulse entries, because you're identifying that, okay, the candles are moving against me, so it's time to cut down on risk. So okay, so this is a really, really good example of consolidation and when not to take impulse entries when price is consolidating. So let's see here. So first of all, we have a resistance formed at this point, right? So we're going to read market based on resistances and support, right? So we got a resistance formed at this point. Looking to the left-hand side, we see this candle, it came up. I just want to make sure if you guys can see the cursor. Yeah, you guys can see the cursor? Okay, perfect. Right? So see, this candle came up. It came up to this same resistance area, but then it rejected it. This does not mean any buys at all because, price even closed bearish here. And the next time price came up over here, this candle closed bullish, even though this candle, it closed bullish above the previous resistance right over here. And if we see that, okay, maybe if this is a resistance and this candle is breaking above resistance and price should now continue moving up, let's say if you just ignore this area right over here, this does not mean that prices now continue to move up. Even though it broke above a resistance here, there's another resistance right over there, right? And now this resistance becomes a stronger resistance because as price breaks a resistance and it moves to a higher resistance, in essence, it's moving to a much stronger resistance, right? And also there's no range here. You can see that there's a very, very small range here. So at this point, there's also no trade. Obviously, you'd want candles to close above this area to look for some sort of a trade for buys, especially, right? We move left over here, we see that candle kind of like tapped into this area again. And then when we move a little bit left here, what we see is that there was a high volume candle. So whenever candles have big bodies, big body candles means that there's high volume in that candle. And high volume mean that that volume should continue, or maybe that was a market open, or maybe there's now volume coming in with the next candle. So this candle had high volume. Next candle was a bearish candle with a little bit of a rejection, which doesn't really mean a buy, but it's still closing above this area. Next candle, we have a bullish candle. This means we should continue moving up because the thing is, we closed bullish, right? We also closed above the previous two candles. We also closed above all these candles here to the left. But at the same time, there's always a probability that price may work out or not. And you can see right here, as price came down to break the low, the buying idea was invalid. So a better idea to take a trade out of sight of a consolidation is to have a big, strong body candle closing above consolidation, right? Because when you can have a big, strong body closing above consolidation, now, this would need some sort of a cognitive thinking. So let's put it this way, right? Let's say that someone took a buy right over here on this candle, right? So your stop loss was down over here. Now, comparatively to the other candles, this candle has a smaller body. Your stop loss is down here. Price comes down, stops you out. You tried the trade, didn't work out. It is what it is, right? Let's say, for example, that this candle was a little bit bigger. Oh, let me get my rectangle here. Let's say this candle was a little bit bigger like this, right? This would have been a better idea to take a buy opportunity because not only your stop loss is far away down over here, but also if the next candle starts moving down, you have an opportunity to close the trade early, which is why it's always better to wait for candles to close outside of a range with a big body. Big body candles means that there's going to be a bigger distance for the next candle to come down to hit your stop loss. And whenever there's a bigger distance, obviously your stop is going to be bigger, but at the same time, if your stop is going to be bigger, your lot size is going to be smaller as well because you're using the same risk. So since there's going to be a bigger distance for the next candle to come down, that could give you an opportunity to really mitigate your risk as price starts to go against you, right? But when you're entering on a small body candle, let's say something that we have right over here, when it's a small body candle, then your stop's right there, and there's a very higher and easy chance for price to hit your stop loss. So it's better to wait for a candle to close with a bigger body or for another confirmation for candle to continue closing above this zone. Because trust me, the longer the price ranges, the stronger the breakout is going to be. Right, so here price is just ranging. So now when we look at it from a support perspective, which time frame we need? Okay, let me just put this under announcement here. This time frame is usually like your 30-minute time frame, 15-minute time frame, because they're strong confirmation time frames, right? If someone is new here joining, this is a advanced webinar, so it's better to read the announcements and read the first steps before joining this webinar. All right, so let's take a look at it from a support perspective, right? So obviously we had resistance formed up over here, and after this resistance was formed, price came down and it basically formed support, right? It formed support, price went up, candle closed with a wick at the top, next candle broke down, next candle came back in. So now this would have been your support, but eventually what happened was instead of creating a support down over here, you see price came up, and then we had this candle retesting the resistance. Next candle formed bearish, and the candle after that closed bullish. So when this candle closed bullish, boom, we got a support form right over here. And if this is a 30-minute time frame, then this is a strong support because 30-minute are good confirmation time frame. So we have a support form right over here. Now we continue going left. You see this candle came and tapped into the support. Boom, this is a strong support. This is another strong support, because look, candles are wicking in this area, but they're not closing below this area, and if we keep moving right, we see more and more candles coming down and tapping that area, right? So once we're tapping into this area, all we need is one candle to close below the support. So we can say that, okay, like, you know what, this candle, so like, let's say this candle closed something like this. So now you can say, okay, like, you know what, all these candles here, they were closing above this range, but then this support, but then we have one candle that broke and closed below this area. So now this is giving us some confirmation that, okay, maybe the next candle is going to continue moving down. So whenever price is ranging, all in all the slide meant here was that whenever price is ranging, do not look for impulsive trades, because, like, you know, you always have to wait for price to break out the range, or, like, you know, if you can get like a buy stop, just like what happened on GJ last week, a buy stop, like, you know, at like maybe like 10 pips away from the range, that may get you a good price. But at the same time, you know, buy stops are still risky. Impulse entries in ranging market, it's also pretty risky. So I would say wait for price to like close above the range, do some sort of retest, and then continue on. How's my pace? My pace is good. Too fast, too slow? I think it's should be okay. Good. All right. Perfect. Okay. Counter trend positions, right? The first thing we looked at, not to take impulse trades in a consolidation. You know, obviously it's going to be very risky. Whenever we're trying to take a trade in consolidation, it's going to be very risky. The next is counter trend, right? Not to take impulse entries when there is a counter trend move. I see people make this mistake all the time. So when price is trending, it's easier to get in an impulse entry and ride the momentum. It's difficult to do so in a counter trend, right? So whenever price is trending, right, price goes up, comes down, creates support, comes up to the high. You're like, okay, there's a very, very heavy trend. There's a lot of volume in the market. You take an impulse entry at this point and price starts to move up. You have a good day. You're like, awesome, perfect. We won the trade, right? But when there's a counter trend, right? What this means is actually, so we're going to talk about that here later on too. So whenever price is counter trending, in a counter trend trade, a candle can flip in the trend direction and you can have a stop loss hit. What this basically means is that, let's say if you have candles moving bullish, right? You have candles moving bullish. We have a trending market over here, you know, very nice trending market. Candles are moving bullish. And then you have some sort of a bearish candles forming like this. Now, someone's going to get a very smart idea. So let's say that price has also reached a very, very, very strong resistance area up over here. You know, and someone says, okay, you know what I'm going to do? If the next candle breaks the low of the previous candle, I'm going to take a sell. That's one big mistake I've seen people make all the time. When price reaches resistance, one candle closing bearish does not mean that we will go down. That's just a little retracement, because what can happen is that the next candle can essentially break the low, but as it's breaking the low, there's a very high chance it can just retrace up as well. You know, which is why it's really, really, really risky. If price is trending up and if you see the next candle breaking the low, that does not mean you can have an impulse entry. You know, the best way to have an impulse entry in a counter trend trade is going to be, actually we're going to talk about that in the next slide here. That's actually very interesting. When to look for a counter trend trade impulse entry. So in a counter trend, a candle can flip in the direction and you can have a stop loss hit. So this is why it's going to be very risky to take a trade when this candle is breaking the low of the previous one once we reach a strong resistance. A better thing to do would be to wait for price to come down, you know, maybe like over here, and then create like a support. Once we create a support, then you know, okay, there's a very high probability for price to continue up now. But if we take a buy from here, and if this isn't enough range up over here, we might get stuck in the trade. Right? So you always have to count the range. If this range is, let's say, 30 pips, then taking a buy after this candle closing bullish makes perfect sense. But if this range is only like 20 pips or 15 pips or even 10 pips, man, it makes no sense to take a buy. Then it's just better to wait for price to kind of like break above this resistance and then essentially continue moving up, right? But the point we tried to make over here was to not to take an impulse entry if we reach a very strong resistance or if we reach a very strong support. You know, and if one candle starts reversing, you take a sell over here. It's very, 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 I would never do that. Never, ever, I would do that. You know, sometimes, here's the thing, right? sometimes what's going to happen is that someone will take a sell as it breaks the low, and price will continue moving down, let's say on gold and GJ. And if that works out, then you're going to have this mindset of, oh, okay, like, you know what, this risky maneuver, it worked out once. So subconsciously, you're going to accept that as, okay, like, you know what, if it worked out once, it has to work out again. It has to work out all the time when you take that trade, but it's very risky because most times it will not work out. Trust me, since I started my thing over here looking for impulse entries and trying to see how I can perfect them, I tried looking at these scenarios as well. And for the most part, they did not work. You know, if they did work, they would move down about 10, 12 pips and move up really, really fast. So it was pretty difficult. If a candle breaks the low of the previous candle in a downtrend and vice versa, then that does not mean is now reversing. Right. The best thing to do is to understand the trend, you know. So I hope we all understand trends here. Let's take a look at counter trend positions, part 2. All right. Now, this is really important, right? Whenever price is trending bullish, it will create a support to continue bullish. Very simple idea. Price is moving bullish, it makes a high, comes down, creates a support, and then continues bullish to retest the high. All this is explained in great, great detail in the candle trend section of the Unlearn and Relearn section. Whenever price is trending bearish, it will create a resistance to continue bearish. You know, it will come down, create support, come up, create resistance, and then come down to retest the low. If price breaks a minor support in an uptrend or a minor resistance in a downtrend, we can assume that the counter trend probability is higher now. What I mean by this is, let's say if candles are moving bullish here, right? We're moving bullish, we're moving bullish. Now someone can look at this and say that, okay, if we're moving bullish, maybe I want to take a buy. And the best time to take a buy is to wait for a support to form. You know, if this is an uptrend, we all know this. So price moves bullish again. We have now a bearish candle forming. And now we have another bearish candle forming. So once we have candles moving up and candles moving down now, we can safely say that we have created a resistance at this point. Right? And now all we need to see is a support formed so that price can come up to kind of like retest the high and go up and, like, you know, do whatever it wants to do. So we have candle moving bearish at this point. We have a candle closing bullish over here. Once we have a candle closing bullish, now we have a support formed at this point. So for example, let's say if this range, if this is a 30 pip range, and you can say, okay, you know what, now there's a very, very high probability for the next candle to continue bullish as long as it respects the previous candle's low, and we can have a good trade, and, you know, price can go up and it's going to be a nice day, right? But what happens is that you have one candle going bullish and then you have a candle closing bearish. When you have a candle going bullish and the next candle closes bearish in the same range, now you can say, okay, now price is ranging. You know, this is the best way to identify a range. And this is all done on 30-minute time frame, 15-minute time frames, right? Because essentially what has happened was that price was moving up. It created resistance. You're like, perfect, we got a resistance formed. Price came down. We created a support. You're like, awesome, perfect. We support formed and we got resistance formed. And now when you got a candle closing bearish, now price is essentially ranging between support and resistance. So now what happens is that the next candle breaks the support. You know, when the next candle breaks the support, now you're looking at to say that, okay, if I was looking for a buy position and candle is breaking a support, maybe this is not a buy at this point, right? Because if we're breaking support, maybe we're now trying to move in the counter trend direction, right? This has happened a lot of times on GBJPY, on gold, on EuroJPY, this whole past month, right? So next candle closes bearish. Now what you can look into is that, okay, if this candle is breaking support, and if the next candle starts breaking the low over here, maybe that's a good opportunity to get in an impulse entry for sells. Because if you can get a next candle to break the support down over here or break the low of the previous one, then there's a high probability for this candle to continue moving bearish, provided it does not break its own low. Where's my its own high? Where's my arrow? Yeah, right over here. So once we're breaking the low, we're anticipating price to continue moving bearish. You know, also understand this really important part. Price was trending bullish. Let's just do this all over again, right, for a better understanding. So we had price moving bullish at first, right over, okay? We had price moving bullish, we had a bearish candle printing. What happened? Boom, resistance formed. Price came down again. We have a bullish candle form right here. We have a support form now. Now we have a support form in an uptrend. And what we have learned is that whenever price creates a high in an uptrend, just wait for support to form. Once the support is formed, there's a very high probability price will continue up to retest the high. So this candle tried to move up, but also there's a probability for this thing not to work as well. As long as you have the probability that price will go in our favor, there's also a less chance that price may not go that way. It does happen all the time. So let's say you were in a buy on this candle, price went up, you went in profits, you secured profits, you put stops at break even, price came down. As this price came down, you're like, okay, you know what? If it had to move up, it would have moved up. So basically it's ranging at this point. And once it's ranging, we have a resistance up over here, and then we have a support down over here. So now we're ranging, right? In an uptrend, we're ranging, creating a support. Next candle breaks the support. Now you start to look at that. Okay, like, you know what? Since we formed a support for price to continue moving bullish. But now, since that support is being broken by a candle, then there's a very high probability price may continue moving down. This is when counter trend positions, they can work. So whenever you see one candle closing bearish at resistance, this does not mean it's a sell. This means that there is a retracement incoming, and after that retracement, there's going to be a support formed, and we can then get this trade moving up. But if the support gets broken, then you can start to look at sells. Sells only work if we break supports, because if we will break a support, obviously price is going to continue down to the next support. Right? But if we're rejecting resistance, that does not mean it's a sell. It just means there's going to be a retracement in an overall uptrend, and we always got to trade the trend. Right? So counter trend, always wait for price to form a support. At the same time, if we're looking at it from a perspective of, let's say, from a selling perspective, let's say what happens is that price starts. So this is a resistance, and price is coming down. Like, we're forming bearish candles at this point. We're coming down, 1 candle, 2 candles, 3 candles coming down, 4 candles coming down like this. And then you have a bullish candle, which closes like this. Once you have this bullish candle closing like this, what you have now essentially is a support formed. Right? Now, since we have a support formed in a downtrend, we know that, okay, for the next candle to continue down, we have to create some sort of a resistance, right? So price moves up, and then you have a bearish candle forming right over here. And if you measure this range, let's say this range is around 20 pips, you're like, okay, awesome, perfect. What we have here is we have a resistance formed in a downtrend. So now there's a very high probability for the next candle to essentially continue down like this, right? In high volume. Right? Price will always go in a trend whenever there's going to be high volume, right? So you're expecting price to move down with high volume. But let's say for some reason that the next candle, it does not go down and it goes up like, let me get my rectangle here, and it goes up like this, right? Essentially what has happened is that we have broken this resistance right over here. Right? Since we've broken this resistance here, now there's a very high probability for price to not go down, but to maybe continue moving up towards the next resistance. This is where you can say that, okay, if you're looking for impulse entries and you have a wick like this and the next candle starts breaking the high of the previous candle, then you can say, okay, you know what? Price is moving down. We were in a downtrend, but since we're breaking this resistance and this candle is closing above this resistance and the new candle is breaking the high, maybe I want to take an impulse entry over here and anticipate price to move up towards the next resistance. Right? This is where impulse entries, they work really, really, really well. So you're always waiting for zones to get broken to take a trade. Like, let's say that would be your resistance zone, your support zone, whatever zone that is. But the main idea is to just wait for price to break that zone. Sometimes, price will move in a way that it will make us think that, okay, price is now moving in that direction where it wants to go, but you always have to wait for candles to close. So we looked at two things. The first thing we looked at, taking positions in a range, it's a big no-no, and then counter trend positions, taking impulse entries in counter trends, also a big no-no. A big yes is that you have to wait for price to create a support in a, let's say, in an uptrend. If that minor support gets broken, right, if price breaks a minor support in an uptrend or a minor resistance in a downtrend, we can assume that the counter trend probability is higher now, right? So we were in an uptrend, price make a support, we break support, so this counter trend is more more likely to continue moving bearish. All right. When are impulse entries valid? This is also very important here. Impulse entries are valid whenever there is a strong trend. We all know this, right? We all know whenever there's a very, very strong trend, there's a very, very high likelihood of price to continue moving bullish and moving bearish. When price is trending, it's creating higher highs and higher lows. So we all understand what higher highs and higher lows are when we look at the candles in trends. Candles move the same way, creating higher highs and higher lows. So things to ask yourself when taking an impulse entry. Right? These are very important things to ask yourself. Are the high time frame candles printing in my direction? Whenever you're looking at impulse entries, just understand this, right? They're very, very risky entries. So to take really good impulse entries, you want a lot of confirmations to be on your side, right? The first confirmation is going to be, are the higher time frame candles printing in my direction? If you're looking for buys, you're making sure that, well, daily is a little bigger, but at least the 4-hour is closing in your direction bullish. Let's say 1 hour is also bullish, 30 minutes also bullish. Then you can say, okay, there's a high probability for price to continue bullish. Has price created a high or a low in an uptrend or a downtrend, respectively? Is there enough range for price to move? Whenever you're taking an impulse entries, we're always looking left to see if there's enough range. If there's only like 5 pip range, taking an impulse entry makes no sense. So you need actual range to the left hand side. Is there volume in the market? Are you looking at the market in the afternoon, like 1 p.m., 2 p.m., when there's going to be less volume, or are you looking at the market when there's a lot of volume there? Whenever there's volume present in the market, then there's a high probability price can fulfill that volume there as well. Is my stop loss a decent size with respect to previous candle or zone? When we're placing stop losses below the candles or below the zones when we're taking impulse entries. Sometimes you're placing stop losses below or above the current candle, which is breaking out as well. So these are very important things to ask yourself whenever you're taking in basically a simple entry as well. The main thing is, are the high time frame candles printing in my direction? This will always help you. So, impulse entries. When price is trending and creates a high or a low in a bullish or bearish trend, respectively. When price breaks the newly created high or a low without forming a minor support or resistance to bounce from, there needs to be clean range to fill to the left as well. So what we mean by this is another idea to take an impulse entry. What this basically means is, let's say that we have price moving up. You have bullish candles. We're moving up over here, very nicely. Very easy, no problems. We're moving up over here like this. Someone's looking at this and saying, oh man, we're moving up. Every candle is moving up. I don't know what to do. I'm missing out trades, this and that. All you got to do is just wait. You wait. And then what happens is, out of nowhere, you get a candle which is closing like this, right? With no wick on the top. You have a candle closing like this. Now what you're thinking is, now since this candle has no wick on the top, candles having no wick on the top, they basically mean, so let's say especially if this is a bearish candle, if it has no wick on the top, this basically means there was no range for the next candle to go up. Because candle moved, like when the candle started, it didn't even move up a little bit and it just moved down. Now, from this stage, two things are going to happen, right? Number one thing is going to be that we may get some sort of a, further movement down to create like a support and then move up. Or what can happen is that the next candle can start to form, something like this. How many people have seen this scenario happen in the market? This happens a lot of times, and this is the best place to take impulse entries. It happens all the time, man, all the time. So if you're inexperienced with impulse entries, you're probably waiting for candle to come down, create support. But if you're vigilant about the fact that, okay, we've seen this situation happen a lot of times, so this makes much sense to say, okay, if we're breaking the high of the previous candle in an uptrend, when that candle closed like a bearish candle, then there's a very high probability for the current candle to continue moving bullish. Right, and this bearish candle is what we call a booby trap candle, and booby trap candles are only for people who are new traders, who are not familiar with how to be fluid in the market. So basically what happens is this booby trap candle, this basically entices people to say that, okay, we've basically reached a resistance and candle has closed bearish. Let's take a sell. And as we studied before, that, okay, whenever price reaches a strong resistance, it doesn't necessarily mean a sell. This is a mistake I used to make in the past. I'd get a candle closing with no wick on the top, bearish candle. I'd look at this, okay, candle has no wick on the top. This means there's no range to go up, so we're not going up. Also, we're at the resistance. Perfect, Raja Banks, take a sell. Boom, I take a sell. And then what would happen was that the next candle would just continue moving up, and it would break the high of the previous candle. And I'll be like, man, this makes no sense at all. But then I saw this happen over and over again. Like a lot of times it would happen over and over again. So then I start to look at that and say, okay, if I'm missing this trade and if I'm taking a sell, maybe instead of taking a sell, I should wait for price to create a support to trade the trend. Or if I'm seeing this happen over and over again, maybe I can enter an impulse entry as it's breaking the high over here, and I can maybe keep the stop below the previous candle, or I can keep the stop below the current candle, right? And anticipate price to continue moving up. And the more times I saw this happen, the more I created a probability in my head that, okay, there's a very high probability for this to continue moving on if it's breaking the high. And if you look at GJ, you look at gold, you look at high volatile pairs, you'll see the same setup happen over and over and over again. Is it good to take impulse entry if the first broke the previous candle low? Aaron, I think you're late. We already talked about that. So whoever is jumping in the webinar in the last half an hour, you will basically have to rewatch the whole webinar. And please don't ask questions. Please leave the questions till the end of the webinar. So, right, that's the best place to take an impulse entry, and that's what this basically means. So now when we read the statement, when price is trending and creates a high or a low in a bullish or bearish trend respectively, that's the right time to take impulse entry. So when price breaks the newly created high right over here, or a low without forming a minor support, so see here, price made a resistance, but it didn't form a minor support, and next candle just broke the high. There needs to be a clean range to the left as well. So as it's moving up, obviously we need to see some clean range to the left as well, right? So this is my favorite step to take impulse entries when we're breaking the highs of the previous, bearish candles, or breaking the lows of the previous, bullish candles there. So right now, what we're going to do is we're going to move on to some examples over here. Okay, perfect. We have some examples here now, right? Impulse entries itself, it's not a very vast topic. It just takes a lot of practice and experience to, maybe kind of see them happen over and over again. Awesome. So what's happening right over here? Right here, as this candle is closing, what we have is a support area to the left-hand side, and this candle is closing below the previous candle right over here, right? Obviously, if the next candle now starts to break the low right over here, if we start to break the low, our stop loss is probably going to be above this candle, which is going to be a pretty big stop loss, So if that's going to be a pretty big stop loss, then it makes no sense to take a trade, even if the next candle breaks the low. Because if you look at the next candle did break the low, but it closed back above this area. If, for example, let's say that this candle was, let's say it was this big, right? Let's say if this candle was this big, then you could take an impulse entry down over here and have a stop above the previous candle and anticipate the price to go down. But since that was a big stop, then we're not looking at impulse entries at that point, right? So we're just waiting to see if we can get a better confirmation for price to move down, or like, if we form like a support over here to go up. All right, what's happening here now? What's the probability? What's the probability of price moving down than to move up? There's a very high probability of price to move down. Now also understand this, right? We're not taking any entries at this point. We're just looking from a probabilistic point of view that, okay, what's the probability of price moving? Now, someone mentioned wick fill. That's absolutely correct, because as this candle closed below the support here, and the next candle closed bullish like a booby trap candle, and now we have this bearish candle forming. So there is no need to wait for a support to for a resistance to be formed, because a resistance is basically, okay, let me just go back to an example here. A resistance, so okay, let's say that we're in an uptrend right over here, and if we form a support, this support means that there's a retest for price to continue up, right? When we have candles closing like this is a retest for price to continue moving down. Either we form either we form like a resistance from structure. That basically means is that you have a bunch of candles. Let's say this candle moved down, and then you have a bunch of candles moving up to create resistance in order to go down. Then you can say, okay, we've done a retest, we create a resistance, and now we can go down. But when you have just one candle coming up like this, and the next candle closing bearish, that's the opportunity for price to continue further down. That's when you start to look at that, okay, if the next candle starts to break the low and it respects its own high, then there's a very high probability for price to continue down. Right, let's see what happens with the next candle. Ooh, see that? Next candle, it did not break the low, right? It did not break the low here. So can we take a buy at this point? No, we cannot take a buy at this point, because what's essentially happening is we're still closing below the support, and when candles now printing side by side, they're basically ranging at this point, right? So sometimes what can happen is that some people can say that, okay, you know what, let's say before this candle formed, you can say that, okay, we're going to take a sell over here, we're going to put a stop above the previous candle, and then we're going to let price go down. But the biggest problem is that it hasn't broken the low. If the next candle breaks the low, then there's a high probability for price to go down. And even if you take a loss after it breaks the low, then you're like, okay, you know what, we tried. But at this point, we did not break the low, so it makes no sense for price to continue down. All right, now what's happening here? It's a new range. Yes, it's a new range. We are not going down. This is a new range because price is closing above this support. It's a new range. We have to wait, right? We have to wait for price to make a lower low, lower high, or a higher low and a higher high to go up or down, right? So now from this point, price can either move down or it can move up. So essentially we're ranging at this point right now. And then we have the next candle closing like this. Now what's happening at this point? Someone said sell with the exclamation mark. I think that's a good idea, because we now broke support in a downtrend, right? So a good idea is going to be to maybe wait for the next candle to break the low over here for price to continue moving bearish, or maybe to close. Now, aggressive entry is going to be to take an impulse entry as we break the low. A conservative entry is going to be to wait for the next candle to form bearish and the next one to go bearish. So kind of like waiting at that point. So when you see these things happen over and over again, you start to understand that, okay, now there's a higher probability for these impulse entries to work out more and more. Because whenever you're looking at the market, when there's a lot of volume in the market, you're expecting price to move in that direction, right? If we look at what happened here, price had a lot of volume. Let's say this was London Open, price started ranging, and I guess then we moved into pre-New York, or if this was Asian Open, price started ranging, and then we started moving into pre-London, because whenever there's going to be a period of high volume, then there's going to be a period of low volume. And whenever we have a period of low volume, that means there's going to be ranging in the market. So then you have to wait for price to close in your direction or to break the low of the candles as well. So once you get this candle closing below this minor support, then there's a high probability that if the next candle breaks the low over here, then we can continue moving down, right? But if we're talking about stop losses, what we're basically looking at is that if we're breaking the low here, right, an aggressive stop is going to be above the current candle which is breaking the low, because if it's breaking the low, you're anticipating price to continue moving down without breaking its own high. That's something you're looking at. If price breaks the low and if it starts to break its own high, then there's a bit of an issue, right? Then you're like, okay, like, you know what, even if I had a risky stop loss, aggressive stop loss right over here, maybe you want to cut down your risk, right? Maybe you want to cut down your risk because a conservative stop is going to be above the previous candle, so you're cutting risk at that point. And if this candle closes bullish in the range, not only you cut your risk, but also once you close position, since the candle closed bullish, you've really, really mitigated your risk at that point, because now you've lost way less than what you planned on losing. So whenever you're taking an impulse entry, just understand and be ready to cut your trade short, because impulse entries are really, really risky and they can go against you. So you need to use less risk in the start and always be ready to cut that risk short, So I think this is a really good example where price range, this candle closed bearish, and you're trying to enter when we break the low over here. So again, I know some people, what they're going to do is they will place their full stop losses above this candle here. No, this is where your partial stops go, because if price breaks its own high, then there's some sort of a confirmation that price may continue bullish and close back in the range, right? All right. Let's move on to the next example here. Oh, wow, look at that. Price came down. So notice how this was some sort of a bigger candle. Bigger candles means there's high volume, and then you had a smaller body candle, and this was your breakout candle, your trading candle. This was a very, very high volume candle because the size of the candle. As the size of the candle starts decreasing, this basically means that the volume is dying. This is where people get really in trouble, right? Because what's happening is, let's say if someone missed this move down, right? If someone missed their move down, now you're going to be more prone to take a sell right over here at the bottom, right? So whenever you see a big candle on the chart and you're not in that trade, just step back and tell yourself that, hey, listen, Mr. Trader, you have missed this trade. Your trade was this big candle. If you've missed this trade, it makes no sense at all to take a sell over here. Because if you take a sell here, where the fuck is it going to stop loss be? Right way all the way up over here. It's way too big of a stop loss, right? Even if you wait for the next candle to form like this, a small body candle, and you take a sell as it's breaking the low, it's still extremely bad, because the candle is closing with a small body, and small body means less volume. And then look at this, even smaller volume, right? So when you miss this trade, all you got to do is to look at it and ask yourself, okay, how could you have been in this trade if you've missed the trade? Because this will happen over and over and over again, and then you got to wait for the next day. So impulse entries are very, very risky. You have to practice a lot. You have to watch it happen over and over again. This is chasing the trade. Yes, Super Redhead, you're absolutely correct. That's chasing the trade when you've missed the trade. Let's take a look at, what's this? Will you incorporate dynamic risk with these impulse entries? Yeah, with practice, you can. You can with practice, because that's a good question for dynamic risk, right? So these are questions I really like. Let's say you opened a sell down over here with, let's say your normal lot size was 1 lot, and you opened the sell with 25 cents, because you're like, okay, it's an impulse entry. I've never taken this entry, and I'm kind of like, hesitant about it. So I'm going to open my trade with a
25-cent lot, you know, and price goes down, you win the trade, you're like, okay, perfect, impulse entry worked, I use a lower risk, it worked, and my confidence is up now a little bit, right? But what can happen is that price can start retracing. If price starts retracing, then you can look at it and say that, okay, if my entry is down here and my conservative stop for my smaller lot is up over here, and if price is retracing, maybe at that point I can add another 25-cent lot, right? So basically what happened is that you added 0.25 right over here, and then you're adding 0.25 right over here. So now you have a total of 50-cent lot open, right? Once you have a 50-cent lot open, and if you see that this candle is now closing, let's say back bullish up in this range, so now you can say that, okay, maybe I want to close my trade. You know, so instead of using one lot, you opened dynamic risk, 25, total 50-cent lot, candle is closing bullish. You're like, okay, maybe this is not going to go down, and maybe I just want to close my trade in a minor loss. You know, so that's where dynamic risk can really help you. You know, what people do is they do the opposite. They will take a dynamic risk trade, and they will keep on taking risk off of that dynamic risk. But the idea is to add risk as price is going against you. So let's take a look at this next example here. All these examples are real examples. Yes, this is taken from the real market here. All right, so what's happening right over here? We have a candle coming bullish, and as it's coming bullish, it's coming up to this resistance area right over here, right? Above this resistance, we have another resistance right over here. And if price comes above this area, we have a clean range here to the left-hand side. So now we got to see that, okay, when will price come above this area so that we can take a trade going up? Or if price will create a resistance in this area or continue moving down. So at this stage, there's no buy because we're at the resistance here. There's no sell because candles are basically bullish, right? So we just have to wait here a little bit. All right, what's going on here? We have candle moving up. We have this candle closing bearish. We have this candle closing bullish, but there's a resistance at this point right over here. So we don't know when to enter because like we can't take a buy because range is right there. We can't take a sell because, you know, candles are basically closing bullish at this point. So we're kind of waiting here. So the next candle goes bullish at this point, right? It goes bullish. Let's say someone was looking for an impulse entry above this wick right over here for price to continue on bullish, having the stop below the current candle, right? This is where someone would look for an impulse entry for price to move up because, you know, let's say also, we're also anticipating that this is a high volume session, right? Every impulse entry that we're going to look at is going to be in a high volume session, which is going to be like pre-London, London Open, pre-New York, New York Open, NYC Open, London close. So we have like a lot of time for impulse entries with high volume, right? Next candle goes up, like, you know, and then, ooh, wow, look at that. We continue down and we break this low, and then that's it, right? We get stopped out. So would it be okay to enter buy instead of... See, this is why I don't appreciate when people ask questions. All your questions are going to be answered while we go through the webinar. I know some people, like, you know, you're really enthusiastic, you really want to get your question in, but trust me, I've been through every possible scenario, and all your questions are going to be answered. So please write your questions on a piece of paper because it's really distracting, not for me, but for everyone else here too. You know, so we got a big crowd here. So let's say we had an impulse entry right here and you got stopped out at break even, but the bias is still buys, because the reason the bias is still buys is because we're closing above this area. Even though this candle closed bearish, we got stopped out, the bias is still bearish. Now, this is an example that we were talking about. If the next candle starts breaking the high, then there's a higher probability for price to continue moving up. That's the only reason you'll be looking at impulse entry at this point for price to move up. Because this move down, this could be like a liquidity grab. It could be like a big liquidity grab, right? So let's see here what the next candle does here.
perfect. Next candle breaks the high and it continues to move up. Now, the problem here is that since we broke the high, we could have taken a buy and price moved up, impulse entry, clean traffic here to the left hand side. The stop is going to be a little bigger right over here. Right? That's why it's really important to lower down your risk. With practice, the more times you see impulse entries work, you're going to be able to gauge the stop loss here as well. And what I mean by gauging the stop loss is that once you see that, okay, before this candle moved up, obviously this candle kind of like consolidated and moved down, created like a big wick, moved up, and then eventually start to move up, right? Now, from experience, what I've seen is that whenever there's going to be a big wick down and we start breaking the high, with experience, you're going to start to look to see that, okay, instead of having a, let's say, a 20 pip stop, maybe it'll be better to have a 15 pip stop, or maybe it's going to be better to have a 10 pip stop right down to the support level. This I'm not recommending to do right off the bat, but with experience, the more time you see this situation play out, you're going to be more then you're going to look at the fact that, okay, how can I have like a smaller stop? How many times is price grabbing liquidity down here and then continuing on, or let's say, how many times, if let's say you take an entry at this point, what's the probability that price will retrace all the way down before moving back up again? Right? So you're going to start to look at those things. What I've started to look at these things is that, okay, whenever price is breaking the high, and if my stop is going to be, let's say, 20 pips or 24 pips, I've come to a conclusion from my own analysis that, okay, maybe having a 10 or 15 pip stop is going to be more than enough to dictate that now price should continue moving up if it's breaking the high right over here. This is extremely, extremely aggressive, and you need to see it happen in front of you over and over again. Yeah, perfect. Let's see what happens with the next candle there. Oh, yeah, perfect. Awesome. We come up over here. So this is what I was talking about here, right? So we had this resistance here, top hand side, and what's basically happened is that if we take a look to the left, we have these rejections here. So since we also broke above this support, having these rejections to the left hand side, it means that, okay, price came up and it rejected here before. So then there's a high probability for price to reject there again. Also because, we're moving up, so we have to come down, create like some sort of a support, and then continue moving back up again. But I guess there's some sort of support being formed here. This does not mean a buy, even though we're closing above the same level. So we're kind of like waiting at this point, and then eventually price just starts to range at this point here. Yeah, we're just ranging. All right. Let's move on to the next example here. I would really advise, if someone's new here, I would really advise to rewatch this webinar again, because I'm going to rewatch this as well, probably day after tomorrow. All right, what's going on over here? We have a bunch of price action, which is ranging at this point. So first of all, what we need to do whenever you look at the charts is to pull up a support, and support's going to be maybe somewhere down over here, because we can see that these candles came down, closed bearish, next candle closed bullish, and then price started to move up. So we basically formed a support at this point. And now price is moving bullish now, right? We don't know whether price will come down to create support to continue up, or will it break below to continue down. Now, since we have the support formed, and if we think price is going to break the support to continue down, what we have to do is to... Would you mind killing the chat, please? The messages are so distracting. Yeah, it's a good idea. Or actually just close the chat box. That's what I did. I closed the chat box. I don't look at the messages. It's like, when you have a class and you have backbenchers talking all the time, and the front benches is like, hey man, shish. It's hilarious. I used to be the backbencher in class. All right, so we have a support form. So if we break the support, where is the next level where price can go? So we're like, okay, if we break that support, there's a very high possibility for price to continue down over here. So basically now we have to wait to see if we can get some sort of a confirmation to see where price is going to go. So we see next candle close bearish. At this point, we cannot take a sell because, we're above the support. We can't take a buy because the candle is bearish. So yeah, we're just waiting at this point. All right, so we got a candle closing bullish. It's closing with no wick at the bottom. Now, this may mean that the next candle can continue down with volume, but the problem is that we have a support down over here, right? And if this is a high volume session, let's say if this is a New York Open or NYC Open, then we know that in those high volume sessions, price is most likely to break a zone. So let's say that in this instance, we're trying to sit out and just watch, and let's see where the next candle goes. So the next candle basically broke the low right over here, right? And this we can say that, okay, like, this was risky because since we had this candle closing with no wick at the bottom, if let's say this support was down over here, then it would make sense to take this impulse entry for price to continue moving down. But since the support was right here, like a few pips away, it made no sense to take a sell. But for practice purposes, for experience, I think this is still pretty good because even though we broke the low and we broke the zone in a high volume session, so this means there's a very high probability in a New York Open or London Open or let's say London close for price to break a zone. Right, so you're keeping these things in mind as they continue on happening. But since we didn't take a trade here, so basically waiting to see what happens next. So next candles move up, it closes back in the range. So essentially just ranging at this point. Now we're starting to move up again. And as we're starting to move up, we have a resistance up over here, right? So this is basically very, very tough price action, and now price starts to move down, right? So basically missed this one trade over here, and now we have price coming down. And as price is coming down, what we're looking at is, so let me just redraw these zones here. So initially what we had first was this support formed, which got broken by this candle, and then we had candle going up, and now we have a new support formed at this point when candle moved up. Candle moved up, it reached this resistance area, and I guess it rejected this minor resistance. Candle came down, and now we're closing below this support. If we're closing below the support, our next support is way down over here. So now we have a range where price can continue down. Right, so we waited. Now we have a range for price to continue down. If we break this low, then there's a high probability that price is going to continue down to the next support because we're moving in times of volume at this time. Let's see how the next candle closes. Oh, next candle breaks low and continues moving down. So this could have been another impulse entry right down over here as we're breaking the lows, but this was a little bit difficult. It's really, really difficult. The most easiest way to look for an impulse entry is to see that if a candle is closing somewhat like this. And these situations, you will see them a lot in the chart. Like if you go back to your charts on GJ or EJ or gold, you will see this situation here a lot. This is complicated here. But now we see candle rejecting that support. So, side by side movement, a little bit of volatility here, and then we start to move down, whatever. But the main idea was right over here. We broke below the support, and as the next candle started to break down, there was a high probability for price to continue down, and it actually worked out. So these things, you'll be able to watch them happen over and over again. But this situation right over here, let's go back here. Let's go back to the previous chart. I guess we don't have that situation. Oh yeah, this situation right over here. These are my go-to trades here. When price does not create a support, it creates this candle, like this booby trap looking candle, and the next candle breaks the high. These are my go-to trades. This works on the weekly, on daily, on monthly, on 4 hour, just go look back at the charts and you'll see that the next candlestick keep on moving bullish. Then we're looking at this situation here. This gets a little bit complicated because this is a little bit more risky because not only you have less range below this low right over here, you also have kind of like the same stop loss. It's also like a 1-to-1. It's still good, but you need enough range for this to work very well. You need at least 20 pip range, 25 pip range. I mean, if this range is like 15 pips or 10 pips, it's going to get really hard at that point. All right. let's take a look at the next example here. So price ranged and did whatever. All right. So we got a candle coming down. This candle closing with no wick at the bottom. It's basically closing below this support here as well, right? As we're closing below the support, we have to go back right over here. Okay, so as we're closing below the support, we cannot take a sell at this point, and we cannot take a buy at this point. Because for sells, the stop is going to be way too big. For buys, I mean, we don't know. Candle's closing with no wick, so this means there's a 50-50 chance that price can either go up or it can go down. Oh, wow, look at that. This candle went all the way down, made a huge wick down, and came right back up. So, you know, like nothing at this point either. So we're waiting for candles to close. So we're getting a candle closing bullish now, right? What does this mean? This means that the candle is closing bullish, but it's not a buy because we got a resistance right over here. You know, so it doesn't even make sense. So basically what's happening here is that we have a support formed, right? We have a support formed. Now, a sell is going to be good if we break below the support. A buy is going to be good if we break above this resistance to go up, right? In both cases, we know that there's going to be very high volume. So we're looking at impulse entries. So we're going to see this. Okay, perfect, right? So this is where we broke below the candle here to continue down, right? This was another impulse entry right here. So this kind of like matches up with the same idea where the candle, it like, you know, we come down, we create support. Instead of creating resistance, price starts breaking the low. This happens in high volume pairs like GJ, gold, EUR/JPY, sometimes US 30, sometimes, haven't really seen US 30 a lot to come to a concrete conclusion, but this we've seen happen a lot of times, right? That price would come down, create support, right? Once the support is created, it should create like a resistance, and then we can continue down. But instead of creating resistance, we start breaking the low. Also, we have a wick here to the left-hand side, making it a high probability for price to continue moving bearish, right? If you look at the next candle, oh yeah, okay, it also continues to move bearish, kind of like fills this wick here, and yeah, that's the end of the trade. And the next candle obviously starts to go bullish. We're moving bullish again. Kind of like seems like we may create a resistance here to continue down. Can't take a sell because we got resistance. Can't take a buy because, you know, we got resistance here as well. So, okay, we're closing back in the range. Now we're back in the range here. Now we're ranging, and now we're starting to come down. But at the same time, we have a support down over here, and we'll need to break the support for price to continue down. And we start to range here, and there was nothing left to see here at all, you know. So this was the best place to have your impulse entry right over here. As you see impulse entries play out more and more, you're going to start to devise your own rules on what's working more or what's not working more. You know, so we got support, we had resistance here, we had support here, price formed support, form a bullish candle, expected the next candle to move up to create resistance, but nope, candle started breaking the low. So once we start breaking the low, there's a high possibility for price to continue down. And when we look at it from a market structure perspective, what it would look like is like this: price came up, came down, made a higher low, made a higher high, right? And then we made another higher low, and then we start to make a higher high. But once we start breaking the previous low, then there's a very high chance that once price is breaking the previous low, we can now continue moving bearish. You know, and this whole market structure, you know, some people call it head and shoulders and whatnot. You know, so at the end of the day, it's all about candles, how candles are closing, how candles are moving, how, like, you know, they're breaking through zones with impulse entries or with confirmations. So that's what all these patterns are. Are those two long wicks an indication of reversal? See, reversal is going to happen if... Now, when people talk about reversals, right? Let's say if price is trending down and you see candles leaving these big wicks, you can say, okay, you know what? This is some sort of a reversal. When we're talking about a reversal, when price is trending down, you're talking about anticipating buys. And the best way to anticipate buys would be, I would say, above this area right over here. Because if price can come above this area, then we have clean candles coming down and we can take a buy here and expect price to continue up to this resistance. That's where you can see buys could work. But reversals here, I think the word reversals is used a lot. And a reversal basically means when price starts moving the opposite way with confirmation, basically. All right. So let's move on here. So I guess that was the end of the presentation here. What I'm going to do now is we're just going to go over some questions, and then we will do a simulation session here. When candles are making lower lows and a small bullish candle is formed, but still respecting previous candle high, making a lower low, and recent candle breaks that. Same scenario. Yes. So, Drep, I think all that explanation is kind of confusing without a chart. Obviously, we can't send a chart here, but I guess what you're asking is explained in this webinar, so you'll have to watch it again, or at least keep questions smaller because we have an audience and it gets really hard for people to really comprehend the questions. After breaking the minor support, so we also use 5-minute time frame to manage risk. No, 5-minute time frame, it comes with experience. You need to get really, really good at managing risk on 15-minute time frame, 30-minute time frame to be able to manage it on the 5-minute time frame. In high volume times, are you taking impulse entry in first half, or do you always wait for the second half of the candle? That's a very, very good question, right? So let's go back here. Let's go back to one of the charts. And okay, let's go back here. So once you have candle breaking above, normally you're taking entries in the second half of the candle. Because what can happen is sometimes what happens is that if, let's say, this candle closed like this, right? And when the next candle started, the next candle can start breaking the high in the first 2-3 minutes. And whenever the next candle starts breaking the high in the first 2-3 minutes, there's a higher probability that price can kind of like retrace to create a lower wick. That happens a lot of times, and that's why I kind of wait for the second half of the candle to break the high. But sometimes the first half can break the high and it can continue breaking the high, it can continue moving on. At that time, you can just like look around and say, okay, you know what? It is what it is. I missed the trade because I was following my rules, and at that time, I'm also open to miss the trade at that point. Fake outs. We can't talk about fake outs because you'll have to go through that fake out section completely and then look at that. Can impulse entries work on small account? Yes. Impulse entries, they're basically candles moving, so they work on all accounts. Is also valid to take impulse entry based on 15-minute time frame. You have to watch the webinar again. Raja and downtrend, if candle break the low and high, then what will be the next move to focus? When a candle breaks the lows and highs, those are volatile candles. So I think then you have to wait for the next candle to form to see what's happening. From never to miss in that case, right? All right, we're getting a lot of questions here. So what we're going to do is we're going to move on to the simulation here because some questions are already answered in this webinar. There are questions about higher highs and higher lows. Those questions are answered in the unlearn and relearn section. So we're going to move on to the simulation here. Guys, you really need to watch the unlearn and relearn section. Most of these questions are answered in there. What's this? Impulse move will be so fast after breaking the high or the low, so is it better to have a buy stop or sell stop? Again, Tarek, you need to watch the unlearn and relearn section. And also you need to watch the buy stops section there as well. All right, so let's move on to the simulation here. So I'm going to stop this right here. And then we're going to open our MetaTrader. All right, so Let's close all windows. Wow, this will be a pretty big file here for 4K actually. So I've been recording in 4K. It's gonna be crazy. All right, let's share this screen here. When we see big candle, can we see a lower time frame market structure to stop loss? Yes. That's very logical. That's what you have to do. Screen 1, screen 2, share screen 1. All right. All right, let's answer this last question and then we're going to move on to the simulation. Counter trend question. If price forms resistance support in an area where to the left hand side, it fits perfectly with another support resistance, can that be used as a No, we mentioned in the counter trend section that if price is moving bullish and then if it forms support, if it breaks support, then you can take a sell. That's it. You know, that's it. If you want to overthink about certain things, and that's all up to you. So you need to back test things a lot. Like a lot of times people don't back test. They don't back test at all. I mean, for some people, they've already blown an account so far, and it's only been 1 month since you started market fluidity. And in November, like a lot of people, they've had a pretty bad week last week last week was a very, very troubling week, and you really need to focus on 1 or 2 trades. Just focus on 1 or 2 trades a day. And honestly, man, you're going to be totally fine. Once you start overthinking, you start over trading, it's just going to be extremely hard. And man, this trading thing, it's all going to be a dream. So what exactly will be back testing this webinar? I think RJ meant exactly what we'll be back testing in this webinar. Basically, what we're going to do is we're going to try to do some simulation here, and during that simulation, we're going to try to see if we can, execute on some impulse entries here or not. So first thing that I'm going to do is I'm going to go to a random date and generator here, random date generator. All right, so let's go over here, and someone said 2020, so that's what we're going to do. We're going to start with January 2020. We're going to go to November. Let's go to like September 2020. Actually, let's start from 2019, September 2019. Yeah, let's do, because we want to make things much more relevant here. Hopefully that disk space doesn't affect the webinar. No, I have a lot of disks. Oh, this thing right here? Yeah, I don't even know what this is. This is my online disk space or something. Your computer's running. Oh, okay, hold on. Let me just check this out real quick. My computer's running low on disk space. Unbelievable. Oh, okay. All right, let's just pause this here for a sec.